Okay, good morning everyone. Welcome to Byju's Exam Prep IAS. This is Shankar Guria. Now, before I start the discussion, if there is no issue with the sound, please give me a thumbs up. Done. Let's start. So, what we have discussed in the last class, right? That is on Friday. We started with the concept of financial market. Okay, in financial market, what we have discussed, financial market will basically be a place where financial instruments are traded, right? What are financial instruments? For example, we have shares, we have bonds, etc. We are not entered into shares. We'll do it in some time. Have patience, don't worry. So, it's a market where instruments are traded, right? Somebody will purchase, somebody will sell, etc. Now, based on for what duration the instruments are traded, is it for short term, is it for long term, etc. We have divided the financial market into two types. One is the money market, second one is the capital market. Money market, why? Because the instruments are traded for a shorter duration, that is up to 1 year. For example, we have repo, reverse repo, commercial papers, commercial bills, etc. And on the other hand, whenever the instruments are traded, instruments are issued for a longer duration, that is, let's say for 2 years, 5 years, 8 years, etc. We have one more market which is called as capital market. In case of capital market, I can further it is divided into two parts. One is the debt market, other one is the equity market. The debt market will deal with those instruments which are used to borrow from the market. Simple idea, which are used to borrow. Borrow means what? The one who is issuing it is coming under a debt. Hence, it is called as a debt market. Right, what about the equity market? We'll discuss that today. In equity market, the issuer is not coming under liability. Rather, the issuer is basically trading ownership. Right, the ownership of the company is traded. That is equity market. Within the debt market, we have discussed the concept of bond, types of bonds, that is a convertible bond, non-convertible bond, inflation indexed bond, and we are discussing new types of bonds. The one novel type of a bond that we have discussed last week at the fag end of the discussion is basically at around 9:15 was the idea of a sovereign gold bond. Yes, GB, sovereign gold bond. Now, let me pick it from there. Let's continue. Next concept is a green bond. Idea of a green bond. Now, first and foremost, look at the term green here. Look at the term green. What do you mean by green? Green generally is associated with climate. Green is associated with environment. Agreed? Green is associated with the climate and green is associated with environment. Now, the basic idea of a green bond is that green bonds can be issued by anybody. Anybody in the sense, these can be issued by government. That is, let's say government of India. These can be issued by government-owned entities. For example, National Highways Authority of India. These can be issued by even private sector companies as well. These can be issued even by the private sector companies. But the whole idea of a green bond is whenever issuer is going to issue these particular bonds. Right? For example, let's say government of India will issue these bonds. Government will basically keep the money that they have collected only for certain projects. Is it okay? I'll repeat it again. Whenever these bonds are issued, money is collected either by the government. For example, sir, any example of a government which has issued sovereign green bonds. The government of India itself has issued sovereign green bonds. I hope you have read about it in the newspaper. Government of India itself has issued sovereign green bonds recently. So government of India has issued, let's say, sovereign green bond. They've collected the money. Now this money will be used only for certain specific type of projects. Right? They are not going to use it for any project, only for specific type of project. And remember, all these projects will be associated with the climate or environment. For example, I'll just give you a common list here. Renewable and sustainable energy projects, solar projects, wind energy projects, for promotion of clean transportation, sustainable water management systems, climate change adaptation reforms, energy efficiency, sustainable waste management, biodiversity conservation, etc. Again, there's a list. From one country to another country, the list can change. But generally, these are the types of projects which are covered here. So one, green bonds essentially are debt instruments. I hope you understand. Essentially are nothing but debt instruments. That is, the one who is going to issue it will come under debt or obligation. Point number two, who can issue this? These can be issued by the government, government-owned entities. An example of a government-owned entity which has issued green bonds in India, National Highways Authority of India. National Highways Authority of India. Private sector companies. An example of a private sector company which has issued green bond. It has been issued by Ford company. Have you heard of the company Ford? The company Ford exited from India. So the company Ford also has issued the green bonds. Multilateral organizations such as World Bank. In fact, World Bank has issued a lot of green bonds. Right? So these are certain very important points. Now, next point. Follow this point very carefully. Some of you will be confused. If you're going to issue a green bond, imagine you're going to issue green bond. Would you want to borrow from the market at a higher rate of interest or lower rate of interest? Let me know. Right? If you're going to borrow from the market at a higher rate of interest or a lower rate of interest, and what should make sense to you? What should make sense to you? You should be able to borrow at lower rate of interest. Or if somebody says higher, why? You should borrow at a lower. You're doing good for ecology. You're doing good for environment. Should the investors promote you or not? Right? So argument is you should be able to borrow at lower rate of interest. Now point number two is, follow this carefully. If you're going to issue the bond at 100 rupees, if you're going to issue the bond at 100 rupees, and if rate of interest, that is a coupon rate, is 6%, right? If it is 6%, is there any way to reduce the coupon rate? Understand this carefully. Is there any way to reduce the coupon rate? No, it remains fixed at 6%. Rather than this, what they do is they will issue these at premium. They will issue this at premium. Remember this. The green bonds are issued at premium. What do you mean by premium? Last class, that is Friday, do you remember issued at discount? Let me know. Do you remember the concept of issued at discount? That is, if the face value is 100 rupees, you will not issue at 100, you will issue at lower than 100 rupees. Now, in case of green bonds, they are not going to issue at face value. Rather, they will issue it at, let's say, 102 rupees. Rather than 100 rupees, they will issue at 102 rupees. What is the meaning of it? Think of this carefully. If you issue at 100, you will pay a coupon rate of 6 rupees. What is the yield rate? What is the yield rate? 6%. Anybody has a problem with this? You are issuing at 100 rupee face value and you will provide a coupon rate of 6 rupees. What is the yield rate here? Yield rate is 6%. But rather than that, if you issue the bond at 102 rupees and then provide a coupon rate of 6 rupees. Why? 6 rupees, please remember this, is calculated on face value. What is the face value of the bond? 100 rupee. The face value will remain 100 rupee only. But you will issue it at more than 100 rupee at premium pricing. Now, if you have issued at 102 and you pay a coupon rate of 6%, you tell me what is the yield rate here? Will the yield rate be less than 6%? Somebody says 8%. Please do the calculation again. Will the yield rate be less than 6%? Can I say basically the company or the government, whichever has issued it, they're not giving 6% returns, they're giving less than 6% returns. So the argument is, remember this, the green bonds are issued at premium. The green bonds are issued at premium so that the burden of payment, in terms of percentage I'm talking, the burden of payment, that is the rate of interest paid by the company which has issued it, will be lower. This process is called as a greenium. Because it is a green bond, this is referred to as a greenium. Greenium, that is a green bond premium. They'll refer to this as a greenium. Okay, so that is the basic idea, right, of green bonds. So point number one, these are debt instruments. Point number two, right, these are issued by various agencies, government, and whenever government will issue them, these are called as sovereign green bond. Sovereign green bond. SGB, sovereign green bond. Again, when I say SGB in this context, don't confuse that with, right, the concept of sovereign gold bond. Sovereign green bond. Okay, so private sector companies are allowed to issue it, multilateral organizations are allowed to issue it. Next, basically these green bonds are issued at a premium price, that is a higher price than the face value, which is called as a greenium. And they do that. Why? There are a lot of investors. Many of you will basically look at it and say, why will investors prefer it? You tell me, have a look at this, you tell me. In the last, let's say 4 to 5 years, have you seen more and more interest in climate change or not? More and more companies are preferring to protect climate or not? More governments are moving towards sustainable growth or not? So there is a higher demand for these kind of bonds in the market. Don't say that, sir, nobody will invest. There are investors, my dear. There are investors, right? There are investors. There's a lot of interest for the green bonds now. Okay, best example is Indian government itself. They have issued 8,000 crore worth of bonds very, very recently. Done. So these are certain points regarding green bonds. Now let me go to masala bonds. Concept of masala bonds. Now first and foremost, let's start from basic idea here. Imagine this is India. This is India. Now let's say there is a company A in India. It will go to USA and borrow from USA. Borrow from USA market. Let's say they borrowed $1. They borrowed $1. Can I simply say that this borrowing done by the company A in foreign currency, there is a risk of exchange rate. There is a risk of exchange rate. Yes or no? And by the way, last week when I was discussing government public debt, right? The government's public debt, I told you what is exchange rate risk. There is exchange rate risk. Now, what if rather than borrowing in terms of dollars, right? I hope you understand. Rather than borrowing in terms of dollars, what if I borrow in terms of rupees? You tell me. Rather than borrowing in terms of dollars, what if I borrow in terms of rupees? Now, do I face exchange rate risk? If I'm the company A, am I facing exchange rate risk here? Right? Absolutely no. I've borrowed. Right? Please look at the example that I'm taking. I don't know where you're looking at. If you're going to borrow from USA in terms of rupees and repay in terms of rupees, my dear, how am I as a borrower taking exchange rate risk? In what way, you tell me? Right? So listen to the lecture very carefully. In case of borrowing in terms of rupees and repaying in terms of rupees, as a borrower, I will not face any exchange rate risk. Why? I've taken rupees and I'm returning rupees. Where is the exchange rate risk here? Am I converting the currencies? Absolutely no. Now, please understand this. Can I call this borrowing as domestic denominated or domestic currency denominated? Can I call this borrowing as a domestic currency denominated? Right? What is the meaning of domestic currency denominated? I'm borrowing in terms of my domestic currency. Point number one. Point number two, can I call this as offshore borrowing? Let me know. Can I also call this as offshore borrowing? What do you mean by offshore? Right? From Indian perspective. Imagine you're in India. You are going to borrow within the domestic market. That is domestic borrowing. And when you go outside India, borrow from USA, borrow from UK, I'll call this as offshore. Offshore means outside India. So have a look at this. Whenever you borrow in a domestic currency, but in an outside market, these kinds of bonds are referred to as masala bonds. I hope it is okay with you. I'll repeat it. Why they will do it, etc. You'll understand. Have patience. Whenever you borrow outside India, offshore market, but in a domestic currency, these kinds of bonds are referred to as masala bonds. Masala bonds. So why specifically masala bonds? Why are we using the term masala bonds here? Generally, the practice is that we will use a term which represents culture of a country. Either generally it represents culture or food of a country. I hope you understand. Culture or food of a country. For example, in high school, you remember, right? The East India Company came to India. For what purposes? Let me know. For what purposes the East India Company came to India? Spices. Right? The other name for spices is nothing but masalas. Right? So the argument is use a term to represent these bonds. Looking at the term itself, automatically you will understand which country is issuing or the company from which country is issuing these bonds. So if you are, let's say, American and you come across the term masala, which country do you think of? Let me know. Imagine you're in America, you're settled in America, you're an American citizen now. The moment you come across the term masala, which is the first country that will pop up in your mind? India. I'll give you one more example here. How many of you heard of baklava or eaten baklava sweets now? Right? This is becoming very famous in India. Baklava sweets. Right? Baklava is a delicacy from Turkey. Very, very famous now. It's a delicacy from Turkey. Very famous in India. Even today in India, it is becoming very famous. So if you come across the term baklava bond, you tell me automatically what will you understand? One, this is a bond which has been issued in outside Turkey. Second, this is a bond which is denominated in currency of Turkey. What is the currency of Turkey? Lira. Turkish lira. Right? Turkey currency is lira. Okay. Now third one, let me give you another example. Samurai. Samurai. Right? Have you heard of samurai or not? If you have heard of it, samurai bonds are issued by Japanese companies. I'll give you one more example. Dim sum bonds. Dim sum. Right? The local equivalent of dim sum bond is nothing but, or dim sum is right, momos. Momos. Have you eaten momos or not? Momos are basically nothing but dim sums. Right? The dim sum bonds are basically Chinese. That is the bonds which are issued in Chinese yuan. Is the logic okay with all of you? Right? So argument is simple. Right? Remember the example so that if there is a question asked, you'll be able to substantiate and prove that you are not simply by-hearted. You also know more than what is given in the book. So the argument is simple. You go to a foreign market and you borrow in a foreign currency, you're taking exchange rate risk. But if you go to a foreign market, borrow in your domestic currency. What do you mean by this? Imagine you've gone to USA. You are the borrower now. I'm a USA investor. Rather than investing in terms of dollars, paying and getting returns in terms of dollars, I will make the investment in terms of rupees. That is whatever is the exchange rate converted into rupees. Right? Let's say hypothetically, sir, what do you mean by that? Right now, let's say $1 is equal to 50 rupees. If the value of the bond is 100 rupees, how many dollars will I pay? If $1 is equal to 50 rupees, value of the bond is 100 rupees, how many dollars will I pay? I'll simply pay $2. And please understand, it simply means that I've invested 100 rupees. I've not invested dollars, I've invested 100 rupees. And you as a borrower will repay the 100 rupee to me and you will also pay interest or coupon to me. right? But the understanding part is, have a look at this. Understand, important part about this is, imagine it was $1 equal to 50 when I invested in a bond. What if when I get the principal back, $1 is equal to 60 rupees? What if when you return the principal back to me, let's say 5 years or 4 years, whatever the tenure is, you'll return the principal 100 rupees to me. What if the exchange rate is $1 equal to 60? In that situation, how much dollars will I get back? I will get back $1.67. Is it okay? I'll be getting back $1.67. In simple terms, I am making payment as an investor. I'm making payment in terms of rupees. I'm getting the returns in terms of rupees only. That is assuming you are an Indian company. These are types of offshore. Offshore means outside India. Whenever the bonds are issued, are referred to as masala bonds. Now, many of you looking at this, you will realize that, sir, why will the foreign investor invest? When you showed that example, right, the foreign investor invested $2, but they're going to get $1.67. Why will the foreign investor invest? The foreign investors will invest because the coupon rate offered is higher on these bonds. Coupon rates offered on these bonds are generally very high. How much? 7%, 8%. So imagine you're going to a country, USA, where the interest rates are somewhere around 4%, and you'll offer 8% rate of interest. You'll offer 8% coupon rate. Are the investors not interested in your bonds? Think of it. Right? Are these investors not interested in your bonds? Right? Of course, they'll be interested. Why? Coupon rate is higher. But market is, right, the market behaves in a very simple way. That is, if you're going to take a higher amount of coupon, you should be ready. You should also be ready to face a higher amount of risk. And what is the risk in this context? In the masala bond, what is the risk? If rupee against the dollar, if there is a volatility in the exchange rate, how much dollars you will get, principal amount or the interest amount, the dollar conversion would be affected to you. Or the amount of dollars that you might earn will be affected by the exchange rate. That is basically the idea of a masala bond. Now, let me know. How many remember? I don't know. Is it okay if I say masala bonds are part of external commercial borrowings? Have I discussed ECB with you? Have I discussed ECB? Have I discussed ECB last week? No. Some of you are saying yes, some of you are saying no. Let's see. If it is there in the PPT after this slide, it simply means I have not discussed. Because it is there in the slide. I know that. Don't worry. Right? ECB, right? Basically, remember this. Masala bonds is a part of ECB. External commercial borrowing. It's part of ECB, external commercial borrowing. If I'm not discussed, it is there in the subsequent slides. Don't worry. I will discuss it. Don't worry. Okay, so bonds are issued in the overseas market. Overseas means outside India. These are issued and repaid in rupees. I'll simply call them as rupee denominated bonds. RBI mandates that original maturity period of 3 years for investment up to $50 million. And right above $50 million, if you're borrowing, it has to have a maturity period of 5 years. The exchange rate risk in case of these types of bonds will be borne. It will be taken up by the investor, not the borrower, but by the investor. Okay. If I'm not discussed, don't worry, I'll discuss it. It will be there in the subsequent slides. If I'm not discussed, I'll discuss it. Now, let me go to the next idea, IPO and FPO. So the bond market is over. We are entering into share markets now. Bond market is done. We are entering into equity market. I hope you remember this. There is a debt market, there is equity market. Let me enter into equity market now. First and foremost, what is equity? I'll come back to this, don't worry. First and foremost, what is the meaning of the term equity? Right, understand this. Equity simply means it is representing ownership in a company. I'll repeat it. Whenever you say I have certain equity in the company, what does it mean? It simply represents you have ownership, certain percentage of ownership in a company. For example, imagine 3 people have ownership in a company, A, B, and C. A has a 50% ownership, B has a 40% ownership, and C has a 10% ownership. Can I now say that A's equity in the company is 50%? Let me know. Can I now simply say that A's equity in the company is 50%? Right? B's equity in the company is how much? 40%. C's equity in the company is how much? 10%. So equity means what? It represents ownership in a company. But when you say 50%, how much is the actual amount of ownership? That you'll only come to know when you issue shares in the market. For example, let's say hypothetically, there's a company XYZ. They want to raise a certain amount of capital from the market. So what they will do is they will issue shares in the market. They will issue shares. What is the definition of a share? Shares represent unit of ownership. Before you start typing difference between this, have patience. Listen to my lecture first. Right? Shares represent unit of ownership in a company. So what do you mean by this? Let's say hypothetically, company XYZ will issue 100 shares in the market. Company XYZ will issue, right, rather 100, let me change the number, 200 shares in the market. And let's say you will purchase 10 out of this. Is it okay? Company XYZ has issued 200 shares in the market and you have purchased the 10 shares out of it. Now, is it okay? Look at this calculation. Is it okay if I say you have 5% equity in the company? Let me know. Is it okay if I say you have 5% equity in the company? Right? That is basically 10 divided by 200. But if I were to ask you, right, rather than saying 5%, if I were to ask you how many units you own, right, because the ownership can also be represented in the form of shares. If you purchase all the 200 shares, have a look at this. If you purchase all the 200 shares, who is the owner of the company? You are the owner of the company. I hope you understand. If the company is issuing 200 and you purchase all the 200, it basically means you are the owner of the company. So if I were to ask you how many units of shares you own, how many units you actually own, now you simply say, sir, I own 10 shares of the company. So always remember this. Shares are represented in numbers, individual units. You'll purchase 1 share, you'll purchase 10 shares, you'll purchase 50 shares, right? You will purchase 500 shares. Whereas whenever you talk about equity, it is represented as a percentage of total number of shares. Is it okay? Equity is a percentage of total number of shares. In this example, company has issued totally 200 shares. You have purchased the 10 shares out of it. So your equity will be 5%. I've given you one more example. Have a look at it. Imagine there's a company ABC. The company ABC has issued 5 lakh shares. 5 lakh shares, number of units of ownership. But you purchase, let's say 20,000 shares out of it. So you will own 20,000 shares, but the equity, that is the percentage of ownership, will be 20K divided by 5 lakh shares. That will translate to 4% of ownership. This is your equity. This is your equity, right? Your equity in the company ABC will be 4%, but how many units you are owning in the company ABC? You are owning 20,000 shares out of 5 lakh shares. Any problem in understanding what is basically the share and equity? Share represents individual unit. How many number of units of shares are issued? Whereas equity represents a percentage of total number of shares. That's a basic difference between the share as well as the equity. For example, let me use current affairs example so that you quickly understand. Whenever you read about Mr. Gautam Adani, right? Whenever you read about Mr. Gautam Adani, has anyone come across the number of shares he owns in the company? Let me know. Again, for that you should have read newspapers. Anybody here who has read Mr. Gautam Adani's related articles, and in any of the article have they discussed how many shares does he own in this Adani enterprise, that, this, etc.? No, they will talk about equity. They will simply talk about equity, right? They'll simply say 70%, 72%, right? 69%, etc., etc. Or else, as many of you are saying, sir, right, we have come across a Shark Tank program. If you have seen the Shark Tank, season 1 or season 2, how many of you have seen that and read saying that somebody selling 10 shares in the Shark Tank, somebody selling 20 shares, etc.? Absolutely no. They talk about percentage. That is equity. They'll say, I'll give you 1 crore rupees for 20% equity, right? I'll give you 50 lakh rupees for 30% equity. Equity, that is a percentage of ownership. Okay, so shares are individual units, whereas equity is a percentage ownership. That is how much shares divided by total number of shares. Okay, so that is the basic idea. Now come to the types of shares. Come to the type of shares. Right, generally there are two types. Traditional concept is more than sufficient. Do not complicate it. Keep it simple. Traditionally there are two types of shares. One, equity shares. Second one is a preference share. One is equity. Second one is preference share. Now, what is the basic idea of equity share and a preference share? Let's say hypothetically, the company has issued a share. You will purchase 10 shares. Just a hypothetical example. Keep it simple now. Imagine a company has issued share. You have 10 shares out of all the shares that have issued. The company will guarantee that out of profits every year, out of the profits that they earn every year, they will give you a fixed amount of dividend, 4 rupees. For every share that you have, for every one share that you have, every year out of profit, the company will give you a fixed amount of dividend, 4 rupees. This is one type of a share. One type of a share. Another way of giving the dividend is 1 year they will announce, let's say 3 rupee dividend. Another year they will announce a 5 rupee dividend. Next year they will announce a 1 rupee dividend because the profits have either increased or decreased. Is the logic okay here? Let me know, is the logic okay? One type of a share where the dividend return or dividend given is not guaranteed. The amount of a dividend that is given is not guaranteed. It will vary from 1 year to another year. Of course, right? It depends on the profits. And in another type of a share, annually out of profits, they will give you fixed amount of dividend. Fixed amount of dividend. These kind of shares are referred to as normal shares or equity shares. And these kinds of shares where fixed amount of dividend is given, that is called as preference shares. It is called as a preference shares. This is a very important difference between a normal share and equity share or a preference share. And many of you ask me, sir, why would anybody invest? It all depends from one investor to another investor. Do not assume you are the only investor in the market. It will vary from one investor to another investor. For example, you might be an investor who wants to take higher risk. Who wants to take higher risk? Now you tell me, between bond, equity share and preference share, where will you invest your money? Think of it. You're an investor who wants to take higher risk. Right? Where will you invest your money? Obviously, you'll jump to equity shares. You'll jump to equity shares. I'm a kind of investor who doesn't want to take any risk. Any risk. Absolutely no risk. Then I'll focus on the bond market. Specifically within the bond market, I'll focus on government bonds. I'll focus on government bonds. Or else, I'm a kind of investor who wants to take moderate risk. Not very high also, not very low also. I want to ensure that I will have an opportunity to sell the share at a higher price. And I also want to ensure that if I don't sell it, I should be guaranteed fixed amount of returns. Can I simply say for those kind of investors, there is a preference share here? Right, so that's the argument here. That's the argument. Right, do not always generalize everything, assuming you are the only investor. There are multiple types of investors in the market. From one investor to another investor, there will be variation in the risk profile. There will be variation in the demand for interest, right, the scope of earning profit, etc., etc. Then, right, so that's a basic idea. That's a basic idea. Okay, so equity shares are given to, right, or basically are referred to as the equity holders or owners of the company. The dividend will depend upon the profits earned by the company. Right, some of you are asking, sir, what is dividend? My dear, we have discussed dividend multiple times now. Right, it basically represents you are not revising. Right, so dividend is a part of the profit given to owners of the company. Part of the profit given to owners of the company. Okay, right, so dividend is given. Right, so where you have discussed. Please open the budgeting concept. In one of the slides, I've written the term dividend. And earlier also we have discussed it. Anyways, so equity shares, those who are owning it, these are called as equity holders or owners of the company. The dividend given to them will depend upon profits earned by the company. And remember this, these will have voting right. Remember this very carefully. These will have voting right. That is, whenever the decisions are supposed to be taken for the company, the owners of the company will be asked to vote. They'll be asked to vote. Can I give you a current affairs example? How many of you remember a couple of months ago, there was a debate around Adani group of companies owning NDTV? Let me know. A couple of months ago, there was this discussion around Adani group of companies purchasing ownership in NDTV. Right, and they wanted to purchase, right, either directly or indirectly, more than 50%. More than 50%. Right, why? Because if you have more than 50%, you are the majority owner. Right, you are the majority owner of the company. And when you are a majority owner of the company, can you not take decisions for the company? Of course, yes. Right, so the equity owners will have voting right. Whereas on the other hand, preference shareholders, these are called as a hybrid instruments. Why hybrid instruments? Look at it. Can I say preference shareholders will carry certain features of a bond as well as equity? I hope you understand. Preference shareholders will carry certain features of equity as well as a bond. Right? I hope you understand. What is the feature of equity? You can sell them. The market prices will change. Right? You have ownership. What about that instrument feature here? You are getting fixed amount of returns. Right? The amount of returns that you're going to get, that is a dividend, is fixed, just like in case of bond. So these are also referred to as hybrid instruments. Carry a fixed dividend, are preferred over equity shareholders in dividend distribution. Look at this. Imagine a company ABC has earned profit. Company ABC has earned a profit. Now they want to give dividends. They want to provide dividends. First preference will be given to preference shareholders. Right? First preference will be given to preference shareholders. After that, equity shareholders will be given dividend. And they will not have any kind of voting right. Right? So these are equity shares, these are preference shares. Now, based on your requirement, you are either going to invest in equity or you are going to invest in the preference shares in the stock market. Done? Now, last week we have seen the term equity and preference. Where I tell you, we were discussing Urban Cooperative Bank. We were discussing Urban Cooperative Bank. In case of Urban Cooperative Bank, with the latest amendment, now the urban cooperative banks are allowed to issue bonds, are allowed to issue equity shares, are allowed to issue preference shares as well. Is it okay? The urban cooperative banks have been allowed to issue equity shares, preference shares as well as the bonds in the market now. Okay, so this is a basic idea of equity share, preference share, equity shares in the market, etc., etc. Now, coming to the previous slides here, what is this IPO? What is this FPO? What is the term IPO? What is the term FPO? What does they represent? IPO stands for initial public offering. IPO stands for initial public offering, and FPO stands for follow-on public offering. Some of the books will write it as a follow-on public offering. Some of the books will also write it as a further public offering. It doesn't matter. Follow-on public offering. Let's use one term. Now, what is this initial public offering and follow-on public offering? And in fact, in current affairs, the term follow-on public offering was there. That was in the context of Mr. Gautam Adani's companies. Now, let's try and understand this. Imagine there's a company XYZ. There is a company XYZ. And this company right now has been started by you and your friend. So there is A and there is B. These are the co-founders. The company which was started by A and B, the name of the company is XYZ. And let's say the company XYZ requires a lot of money now. Is it okay? The company XYZ requires a lot of money. So why will they require money? They want to launch one more product. They want to expand manufacturing. They want to purchase one more company. They want to, right, let's say, right, open up many more branches in other cities, etc. Again, doesn't matter for what purpose they require, doesn't matter, they require money. That's very important here. Now, what they can do is, they can go to the market, right, that is the financial market, and issue shares in the financial market. Now, before going forward, let me ask you a very simple question, right, and because I know that every class the students will ask me this. Do you think they're doing the same thing in the Shark Tank? Understand the difference here? How many of you think, right, the process that I've explained here is, A and B will go to the financial market, and they will issue shares to people, you, me, companies, financial institutions, etc. How many of you think this same thing is happening in the Shark Tank? Absolutely no. Right? Some of you are saying yes. How? I don't know. Right? When I give you example also, you don't listen then. Right? So basically, in case of Shark Tank, no, they're not doing it. They're not going to the financial market. They're basically going to the investor. They're going to one or two investors. So understand the basic idea here. They will go to the financial market and they will issue shares to the public. Public means what? That's the reason the term public is there in the name here. Right? Have a look at this. That's the reason the term share. That's the reason the term public is there in the name here. What do you mean by public? You are part of the public. I am part of the public. Until now, we were not allowed. We did not have any kind of ownership in the company XYZ. But now company XYZ has come to the market, is issuing the shares to the public for the first time ever. So whenever a company will issue the shares for the first time ever, I will call this as initial public offering. Any difficulty here? Whenever the company will go to the financial market, will issue the shares for the first time, remember this. For the first time ever, this is called as initial public offering, IPO. Can I give you examples in recent times? Paytm, Zomato. Can I simply say in the last 1.5 years, or let's say 2 years, right? So Nykaa, etc. Yes, many companies have done it. So there are multiple companies which have basically issued the shares for the first time ever to the public. Which means now you can purchase the shares of Paytm. I can purchase the shares of Paytm, although nobody wants to do it now. You can purchase the shares of LIC. I can purchase the shares of LIC and I can sell it. You also can sell it. So until now, until the IPO was done, the shares were not available to public, right? We were not allowed to trade the shares. But now, once the IPO is done, it is also referred as a listed company. It is also referred to as listed company. Once the IPO is done, the company is referred as a listed company. What do you mean by listed company? In the stock market, the company is listed. The shares of the company are available in the stock market. You can purchase them, you can sell them. That is basically the concept of initial public offering or a listed company. Is it okay? Right, sir, what is the stock market here? Bombay Stock Exchange, National Stock Exchange. Right, these are basically the stock exchanges, major stock exchanges in India. So you can go to the stock market, purchase the shares of the company and sell the shares of the company. So whenever the company will do it for the first time ever, we call this as initial public offering, IPO, initial public offering. And right, let's say this company that I've taken as an example here will conduct their IPO in 2020. Can I call this as a listed company now? Of course, yes. Now, what if in 2030 again they want to issue shares? Is the logic okay? In 2030 again they want to issue shares. Allowed? Of course, yes. Of course, they are allowed. But again, please understand, they will have to take the approval of SEBI first. There is a market regulator, Securities Exchange Board of India. First, they will have to take the approval from SEBI. Then they are allowed to issue the shares. So whenever a listed company in future again will issue shares, this is basically referred to as follow-on public offering. Any issues here? Whenever a listed company in the future will be issued, right, or will be issuing shares again, it is called as follow-on public offering. Can we do FPO again in 2040? Possible. Can we do again one more FPO in 2060? Again possible. So IPO is done once, then the company is called as a listed company. And this listed company in the future is allowed to issue shares. Of course, with regulatory approvals, those issuances are called as follow-on public offering. FPO, follow-on public offering. Any problem? Let me know now. Any problem? Let me know. So IPO and FPO. And once the company is listed, it is called as a listed company, right? It is present in the stock market. You will purchase these shares, you will sell these shares, etc., etc. From where will the shares come from? FPO. In the FPO, the owners can sell the shares. For example, I'll give a very simple example. IPO is conducted. The owners will still hold, let's say, 60% of the company's ownership, and only 40% of the shares are sold in the market. So now owners can further issue out of 60%. Again, all these are very technical concepts. The owners in the future can issue, let's say, out of 60%, they might issue under 30%. That is an FPO. Or else the company can create more shares, issue those in the market. That is also an FPO. There are two ways through which you can conduct FPO. Okay, so IPO and FPO. FPO to public or limited? My dear, once you have done IPO, generally you'll go for FPO to public only. Right? Because the shares are available in the market already. I hope you understand. The shares are available in the market. Generally, they will go for the public. Okay. Voting in equity share. My dear, voting means you'll have to take decisions, right? Right? I hope you understand. You'll have to take decisions. So what kind of decisions? What should be the salary of CEO? Right? Should we replace the CFO? Should we expand operations? Should we restrict the company's manufacturing? These are decisions. So when you want to take decisions, you will take voting because the owners have to decide. You will take the voting of the owners. That's the basic idea of voting right in case of the equity market. Now, whenever you talk about the public offering like this, there's a concept called as a primary market and secondary market. Right, the idea of a primary market and secondary market. What is this primary market? Have a look at this. In the primary market, the shares of the company are issued. In the primary market, the shares of the company are issued. Who is the issuing authority here? Please look at the picture. Don't say both are one and the same. In the primary market, who is issuing the shares? Can you see the arrow mark? The company is issuing the shares. The company is issuing the shares. Now, imagine you will purchase the shares. You want to sell them. You want to sell these particular shares. You will be allowed to sell these shares in a stock market now. You're allowed to sell. It's not that you're not allowed to sell. You're allowed to sell those shares. Right? You will be allowed to sell those shares in the market, which is called as a secondary market. It is called as a secondary market. Example of a secondary market is Bombay Stock Exchange, National Stock Exchange, BSE and NSE. So idea is simple here. Please look at the picture again. Whenever you will purchase the shares or in a market where the issuer is issuing the securities, that market is called as a primary market. Whereas whenever the instruments which are already there in the market are traded, right, these are called as a secondary market. This is referred to as a secondary market. Now let me ask you a very simple question. Think of it and answer. All of you know that RBI will purchase G securities. Is it okay? RBI will purchase G securities. Now let me ask you a question. Will RBI purchase G securities in the primary market or secondary market? Think of it. Will RBI purchase G securities from the primary market or secondary market? We have discussed it, but I'm using a technical term now. Let me see how you think. Right? From where do you think RBI will purchase, primary or secondary? It is secondary. Right? Many of you are saying primary. How? Let me know how do you say it is primary? Who is the issuing authority of G securities? Who is the issuing authority of G securities? Is it RBI? No, it is the Government of India. Government of India is the issuing authority of G securities. Now tell me how many times we have discussed the fact that RBI is not allowed to purchase G securities from Government of India. You tell me. I hope you understand. How many times we have discussed the fact that RBI is not allowed to purchase G securities directly from Government of India. Whereas on the other side, I've told you, RBI can purchase G securities from banks. RBI can purchase G securities from you. RBI can purchase G securities from the market. Is it not a secondary market? Is it not the secondary market? Right? So RBI is allowed to purchase the G securities in the secondary market, not from the primary market. Again, the idea of a primary market and secondary market is not just associated with shares. It's a concept. Primary means the instruments are coming from the issuer. Secondary means the market already has instruments. We are trading these instruments now. That is basically the idea of a primary and secondary market. Now, who are allowed to issue or who is allowed to invest in this primary market? You are allowed to invest. I am allowed to invest. Banks are allowed to invest. Mutual fund companies are allowed to invest. Right? Many other investors are allowed to invest in the primary market. We are also allowed to trade in the secondary market. We are also allowed to trade in the secondary market. This is the basic idea of a primary as well as a secondary market. Primary as well as secondary market. What is the need for owners to sell their profits and shares to someone? Who said you are selling profits? You tell me. Who said you are going to sell profits? Right? Have you not seen the situation where a person will start a company, will sell the company to someone else? Same logic. Rather than like selling the whole 100% company to only one investor, you are selling it to other investors. Right? You want to generate money, you want to earn money. Okay, so primary market as well as secondary market, have a look at it. The company will issue the shares to the public for the first time ever. Right? This is called as going public. Publicly traded company, listed company, etc. So whenever the company will issue the shares for the first time ever, it is called as an initial public offering. And after this, it is called as follow-on public offering. Once the IPO is conducted, we'll simply say that the shares of these companies are available in the market. Right? The shares of these companies are available in the market. You can purchase, I can purchase, you can sell, I can sell. Right? Hence the company is called as a listed company. What about secondary market? The shares have been issued by the company in the primary market. Now these are available in the secondary market. That is, let's say Bombay Stock Exchange, National Stock Exchange. You can buy, you can sell, right? Trade these particular securities in the secondary market. Okay. Now this is the discussion regarding primary, secondary, stock market, etc., etc. Any issues? Can you go to the next concept here? Right? Again, in the context of this, there is a term called as a bull. Right? They'll simply say bull market. Right? What do you mean by bull market here? Bull market simply means the market prices of the shares are actually going up. Right? The market prices of the shares is going up. Market prices are going up. And what is the advantage of market prices going up? You have purchased the share in the market at, let's say, 100 rupees. Now the market prices are, let's say, 150 rupees. You will sell it at 150. Will you not earn a profit? Capital gains, not a profit here. It's a capital gains. Are you not earning a capital gains of 50 rupees? Think of it. Are you not making a capital gains of 50 rupees here? Yes. Right? This is basically the advantage of bullish market or bull market. Then there is a bear market as well. Then there is a term called as a bear market as well. What is the meaning of bear market? The stock prices are continuously declining. Stock prices are continuously falling down. Right? Continuously falling down. That is called as a bear market. And in bear market, the short sellers will profit. Short sellers will make a huge amount of a profit in the bear market. Right? What is the idea for shorting here? Right? I think I've discussed it again, not in this class, but in many other, let's say YouTube videos, etc. Shorting basically is the idea. It's a concept wherein, understand this, I will borrow the share from you, I will sell it in the market and get money. Right? Let's say 100 rupees. But after, so here also I've discussed. Great, then I'll simply summarize it. After a certain time period, the market price of the share will fall down. I will purchase it at lower price. I will give the share back to you. Right? This is the basic idea of a shorting, process of shorting. So you tell me if there is a bear market. If there is a bear market, will the short sellers not make gains here? Will they not earn profit in the, let's say, bear market? Again, the answer is yes. And the answer is simply yes. So in the bull market, basically the prices will go up. You will sell it at higher price, book profit. In the bear market, prices will go down. Right? Basically, you will sell it and make profit. That is basically the idea of a bull market and bear market. And in the context of NSE and BSE, remember this, the sensitivity index, right? The representation of BSE is called as Sensex. BSE, that is the Bombay Stock Exchange. The stock market index is called as, right, Sensex, sensitivity index. And here, in the context of NSE, it is called as Nifty. It is referred to as a Nifty, right? A Nifty, that is a NSE 50, it is in short referred to as Nifty. So in case of NSE, the index that is used is Nifty, and in BSE, it is called as a sensitivity index, that is Sensex. Okay, so these are certain important points regarding equity market, right? Let's say bond market, etc., etc. Please be very careful. Okay, so how bear market will make profit? And if I've discussed it earlier, again, my only concern with all of you is most of you do not revise it, right? Let's say a simple example. Imagine you have a share of Adani company. Follow it now. You have a share of Adani company. Right now, the market price of Adani company share is 100 rupees. I will borrow it. Can you understand the term borrow? Let me know. Can you understand the term borrow here? I will borrow it from you. And today, I will sell it. Tell me how much money I will get. How much money I will get today? I will get 100 rupees. So I have 100 rupees. After 1 week, the market price of Adani company will fall down to 70 rupees. Right? The market price will fall down to 70. Bear market. Okay. So when the prices will fall down to 70 rupees, I will use the 100 rupee that I have. I will purchase the share of Adani company and I will give it to you. I've borrowed one share. I will give it to you. So I've earned 100, out of which I've used 70. How much is my profit here? How much is my profit here? My profit is 30. So whenever there's a bear market, the short selling, this is called short selling. Short selling, what is short selling here? You will borrow the instrument, sell it, and you will purchase it at a lower price. Understand this. You will borrow, you will sell it, and later purchase it at a lower price. In a traditional concept, what do you do? You will purchase low, sell high. Is the sequence okay? Let me know. You will purchase low, sell high, make profit. In a short selling system, you will sell high, purchase low. Sequence has changed. Focus on the sequence. First, in the traditional concept, you will purchase it at low, then you will sell it at high. But in short selling, first you will sell it at high, then purchase it at low. That sequence is important here. Don't say, sir, buying and selling is happening. What is the sequence? That will determine are you a traditional investor or you are a short seller. So whenever there's a bear market, short sellers will gain the profit out of it. Okay. So this is a basic idea of primary, secondary, right? Equity, preference, shares, etc., etc. Okay. Now let me go to the next concept here. External commercial borrowing. ECB, external commercial borrowing. Now what is this external commercial borrowing? External commercial borrowing refers to a facility wherein commercial entities, companies in India, are allowed to borrow from external market. I'll repeat it. What is external commercial borrowing? The commercial entities in India, that is the companies in India, are allowed to borrow from external market. External market means what? Outside India. Companies in India are allowed to borrow from external market, that is called as external commercial borrowing. So when you say borrow, what does it mean? They will borrow in the form of taking a loan from a bank. They will borrow in the form of, let's say, issuing bonds, etc. Right? Either they will issue, right, a bond, borrow from external market. They will go to a bank, borrow from external market. Okay, so this is called as external commercial borrowing. Now, next point. Whenever they borrow, they can borrow in a foreign currency. They can borrow in a foreign currency such as dollar. They can borrow in a domestic currency, that is rupees. They're allowed to borrow either in a foreign currency or in a domestic currency. Either way, it is allowed. Now, I hope you understand. Is it okay if I say, look at my statement now. Is it okay if I say masala bonds are part of external commercial borrowings? At least now. Right? Can I say that masala bonds are part of external commercial borrowings? It's a part of ECB. Okay. Next, sir, who is allowed to borrow? What kind of companies are allowed to borrow under ECB? Those companies wherein they are eligible to attract foreign direct investment. I'll repeat. Any company in India which is eligible to attract foreign direct investment. For example, what do you mean by foreign direct investment here? A foreign company will bring dollars into India, invest in the Indian market. I'll repeat it. What is foreign direct investment? A foreign company will bring money into India, invest in India's market. What kind of market? Let's say they will invest in manufacturing. They will invest in civil aviation. They will invest in broadcasting, etc. Best example for this, let me know. Have you heard of Volkswagen company? VW. Have you heard of Volkswagen company or not? Right? VW cars. Now, is it okay if I say it's a foreign company? Point number one, it's a foreign company. Second, they have invested in the manufacturing of automobiles in India. Now, let me know, can I call this investment as a FDI? Is it okay? Can I call this investment as FDI, foreign direct investment? Now, beyond this, don't worry. Later, right? That is in the next week, we'll discuss how FDI will come into India, how FII will come into India, where they will invest, how much they are allowed to invest. Everything we'll discuss. But right now, this concept is more than sufficient. So, any company which is eligible to attract FDI is eligible to borrow under external commercial borrowing. That is ECB. Now, annually, how much they are allowed to borrow? Until very recently, they were allowed to borrow up to $750 million. Right? Until very recently, they were allowed to borrow up to $750 million. But last year, Reserve Bank of India has doubled it to 1.5 billion. I'll tell you the reason, don't worry. Last year, RBI has allowed, right, this to be expanded up to 1.5 billion, doubled it to 1.5 billion. Now, why has RBI done it? Let me ask you a very simple question. If you are allowed to borrow up to 1.5 billion, you will borrow more from the external market, bring dollars into India. Is it okay? Dollar inflow into India will increase. Any problem with this? Now, please remember this particular point. We wanted to attract more and more dollars into India. The reason is very simple. Because it is technical, I have not added that point here. Later, we'll discuss it. In the last 1 year, there has been a pressure on forex reserves in India. There has been a pressure on forex reserves. Now, don't ask forex reserves, why pressure, etc. For that, I need to discuss exchange rate first, which we'll do in today's class. We'll continue in tomorrow's class. So, right now, simply understand this. Until very recently, it was $750 million. Now, this has been doubled to $1.5 billion because we want more and more inflow of dollars into India. Now, why will the companies borrow? What are the advantages? Why will the companies borrow under external commercial borrowing? One of the reasons is now they'll be able to get access to more markets. Is it okay? I'll repeat it. Now they will get access to more markets. That is, rather than borrowing only from the Indian market, now they will have access to European market. They can borrow from American market. Now that is one advantage because you have more options. You can choose from which market you want to borrow. Point number one. Point number two. What if I say in the American market you can borrow at 6% rate of interest, but in the Indian market rate of interest is 9%? You tell me where you want to borrow. I hope you understand. In American market rate of interest is 6%, but in the Indian market rate of interest is 9%. Where do you want to borrow? Right, sir, India. Why? You would want to borrow in American market, my dear. Some of you are saying Indian market. Why? Right, you want to borrow at 9%. You want to borrow at higher rate of interest. Why? What is the logical reason behind that? Let me know. I'm saying in America rate of interest is 6%. In India, it is 9%. You want to borrow in the Indian market. How? How does that make sense? You would want to borrow in the American market. So can I simply say one more advantage under ECB that the borrowers will enjoy is lower rate of interest. Lower rate of interest. That is also one reason they will borrow. Third one, imagine today $1 is equal to 100 rupees. Last year it was $1 is equal to let's say 70 rupees, just hypothetical example. Last year it was $1 is equal to 70. Today it is $1 is equal to 100 rupees. And you want to import a machinery. Right? You want to import a machinery. You tell me what makes sense to you. Borrow in dollars and use it for importing of the machinery, or convert your rupees into dollars today and import machinery. Let me know, as an importer, as a manufacturer, what makes better sense to you? Would you want to convert your rupee to dollars and then basically import machinery? No, some of you are saying conversion. It doesn't make sense to you. Doesn't make sense. Why? That's the reason I gave you context. Last year it was $1 is equal to 70. Now it is $1 is equal to 100. So for, let's say, machinery cost is $1. Let's say hypothetically machinery cost is $1. So you want to convert your rupees into dollars now. You're paying more and more rupees for that. What if after 1 year it is again lower? $1 is equal to let's say 87 rupees. Is it not helping you by postponing a conversion like this? So borrowing in dollars makes better sense. Pressure on, let's say, the requirement of dollars in the domestic market automatically will be controlled. Right? So these are some of the advantages associated with external commercial borrowing, ECB. Now, having said so, what are the concerns? What are the problems here? First one, if you keep on borrowing more and more money, and exchange rate will get more and more worse. That is, have a look at this. $1 is equal to 100. When you borrowed, $1 was equal to 100 rupees. But after 2 years, after 3 years, when you're supposed to repay it, what if it becomes $1 is equal to 150 rupees? Now let me know. If you're going to borrow and the exchange rate becomes much more worse, will it not affect your repayment? Will it basically not have an impact on your repayment? Yes. Right. So volatility in the exchange rate is always a concern. It is always a concern. Okay. Now more and more credit is available at cheaper rate of interest. You are able to get more and more, right? Let's say loans at lower rate of interest. Will you be utilizing the money very efficiently, or you'll be relaxed? Think of it carefully. You are able to get loans from India, UK, USA, etc., etc. More money is available. Will you utilize the resources very efficiently, or you'll have a cavalier approach? That is a relaxed approach towards the money. You will be relaxed. You will have a relaxed approach. You will not be worried about efficiency. Can I give you one example? All of you, at least let's say most of you, are writing exams next year. Right? Don't you think most of the times you'll keep on telling your mind, 1 more year is there. 12 months are there. Don't panic. We will do it aram se. Right? We'll go slow and steady, wins the race. But imagine now you have entered into December 2023. Now tell me. Right? You are in, imagine early morning, I know. Right? Imagine you're in December 2023 and May 2024 exams are there. 5 more months. Now tell me, will you have the same cavalier approach, relaxed approach towards UPSC? Absolutely no. Apply the same logic here. I hope you understand. Apply the same logic. You can borrow, right, in India, you can borrow in USA, you can borrow in UK. Will you be using the money very, very efficiently? No. Because more and more credit is available, you might become, or you might have a relaxed approach towards efficiency of utilization of money. Right? Next one, will increase the dependency on foreign funds. Companies will become more and more, right? Companies will become more and more dependent on the foreign market rather than the domestic market. And that's a problem. I hope you understand. That's a problem. Why? If you have to repay the loan, let's say in terms of dollars, can I say dollars will start flowing out of India? Repayment. I'm not talking about borrowing. I'm talking about repayment now. When you borrow a huge amount of money, let's say this year, after 3 years, can I say that there is outflow of money? Let me know. There is outflow of currencies from India. Now, don't you think that will put a lot of pressure on dollars which are available in India? How you'll understand? Don't worry. Dollar going out of India, dollar coming into India has huge impact. You'll understand it. Have patience. Next one, very high borrowing in the form of debt usually is right, a concern in the market. Investors are always worried about more and more borrowings of a company. Why? Let me give a current affairs example. Right? How many of you read in the newspaper, Mr. Adani, right? That is Adani group of companies have borrowed a lot of money from the market. Right? And that was also there in the current affairs. Understand that's a concern. The Adani group of companies have a huge amount of a debt. They have borrowed huge amount of money. So why it is a concern? Right? Follow this carefully. Imagine you are a shareholder. Think of this. Imagine you are a shareholder, and right on the other side there is a bondholder, and here is a company. Now tell me, between shareholder and a bondholder, to whom the company will guarantee, right? To whom the company will provide the money in a guarantee, in the sense guaranteed returns are provided. Let me know, between shareholder and a bondholder, right? Who is going to get guaranteed returns? Bondholder. Any guarantee for a shareholder? Any guarantee for a shareholder? Absolutely no. Meaning what? If the company borrows, keeps on borrowing, shareholders will get it only when they earn profit. But what about bondholders? There is a guaranteed payment here. Coupon has to be paid. Right? Don't you think there is a huge amount of payment pressure on the company? There is a huge amount of payment pressure on the company when there is a debt, when there is a borrowing done like this. Right? That is the basic idea. That's the basic idea. When you keep on borrowing more and more, either Indian market, external market, doesn't matter. When you borrow more and more, the shareholders, investors in the market will be concerned about it. Why? What if borrowings are so high that, right, you are paying huge amount of interest, and that is affecting finances of the company. Okay, so this is the discussion regarding the concerns regarding the idea of external commercial borrowing. External commercial borrowing. Done. Okay, so this is a basic idea of ECB. Please be very careful. Right, a lot of time in the current affairs it will be there. Let me go to the next concept here. Right, P notes, participatory notes, P notes. For what purposes ECBs are made? You can borrow ECB for purchasing a machinery, for expansion activities, etc., etc. Just like a borrowing. I hope you understand. Just like borrowing, right? Just like borrowing in India. For what purposes you will borrow from India? You will borrow for purchasing machinery. You will borrow for expansion of manufacturing activity. Apply the same logic. Okay. In case of AT1 bonds, if the bonds are written off, then the investors get equitable money by converting the bonds, or banks only keep them. If the bonds are written off means those are useless. They will not exist in the books only. I hope you understand. If the bonds are written off means what? The bank has a balance sheet. In the balance sheet earlier, they had written bonds. Let's say worth 100 crore rupees. Now they're simply cancelling that item. Cancelling means it will be taken out of the balance sheet. Right? Even if you have a bond, it is worthless. That is AT1 bond, it becomes worthless. So last point in case of ECB, right? Have a look at this. What is the last point here? Will help the companies to import machinery. That is, let's say, right now $1 is equal to 100 rupees. Rather than converting a rupee to dollar like this, because rupee I'll have to pay more, what I will do is I will borrow from the external market, use the money for importing machinery. right? So I do not have to borrow I do not have to, right, basically convert the rupee to dollar because the exchange rate is not in my favor. Okay. Next, participatory note. P notes. Participatory notes. What is this idea of a participatory note? Let me start with the picture here. Look at the picture, follow the discussion. Let's go point by point. Imagine you are an investor. You are sitting in USA. You are there in USA. Okay. Right. So understand this. You are in USA. You have a lot of money. You want to invest in Indian stock market. You want to invest in Indian stock market. Can you directly bring your money, invest in the Indian stock market without any regulatory approval? Is it allowed? Again, I know you might have not read it, but apply basic common sense, you'll understand it. Without taking anybody's permission, can you bring your dollars into India, go to the stock market and purchase the bonds or purchase shares? No, it will not be allowed. Why? There's a regulator in India, SEBI, Securities Exchange Board of India, right? SEBI. So if you want to invest in the Indian stock market, you will have to take the approval from SEBI. Now, many investors do not like it. They simply say, no, sir, I don't want to take approval. Why? It is a time-consuming process. It is a time-consuming process. In many of the cases, they will take 2 months, 3 months to give you approvals, right? They will also demand a lot of documentation from your side. So for whatever reason, you as an investor will simply say, sir, I'm interested in investing in the stock market, but I do not want to take the approval of Securities Exchange Board of India. So is there any option available to me? Tell me if there is any other option. In case of India, we have a tool called as a participatory note. We have a tool called as a participatory note. Now, what is this participatory note? Let me explain it. Here is an investor who is registered with the SEBI, which is a registered foreign institutional investor, such as a mutual fund company, right, investment company, or a brokerage company, etc. There are many institutions. These foreign financial institutions are already registered with SEBI. And because they're registered with SEBI, they are investing in the Indian stock market. They're already investing. So what these institutions will do is, they will collect the money from you. Look at the term here. They will collect the money from you, and in return, will issue one instrument. I'll repeat it. They will collect the money. That is, they will collect your investments, and they will issue instrument to you. Instrument. That instrument is called as a participatory note. Now you'll ask me, sir, what is the use of a participatory note here? This foreign institutional investor, imagine that is me. I've given a participatory note to you. I've taken your money. Now I will use that money to invest in the stock market. I'll simply take that money, invest in the stock market in India. Now look at this and let me know. Point number 1. Have you indirectly invested in Indian market? Let me know. Point number 1. Have you indirectly invested in the Indian stock market? Point number 2. Right? Can I simply say that? Sorry. Can I simply say that you have not taken any regulatory approvals from SEBI, even then your money is there in the Indian stock market? Is the point clear with you? Point number 3. Can I say that all of this is happening? That is, an institutional investor issuing, collecting money, etc., etc. All of this is happening in the offshore market. All of this is happening in the offshore market. That is outside India. You're sitting in USA. I'm a company from USA. I will issue a participatory note, take your money, I will invest in the Indian stock market. So where is this issuing, collection of money, where all of this is happening? Outside India, that is offshore market. Now, is the logic of participatory note okay with all of you? Let me know. Is the logic of participatory note okay with all of you? Right? It's a type of an instrument. Simple. It's a type of an instrument which is required for the foreign investors. I repeat, it's a type of an instrument which is required by the foreign investors to invest in the Indian stock market without taking any approval of regulator. I'll repeat it. It is basically an instrument issued or instrument required by the foreign investor to invest in the Indian stock market without taking any approval of the regulator. You do not have to take any approval of the regulator. Even then, you can invest in the Indian stock market, but through this route. You're not allowed to invest directly, but through foreign institutional investors. And P notes are offshore market instruments. These are offshore. Offshore means outside India. Offshore market instruments. That is basically the idea of a P note. Have a look at it. Participatory notes, also referred as a P notes or PNs. These are financial instruments used by the foreign investors to invest in Indian securities market. But what is the advantage of this? They do not have to be registered with the SEBI. Some of you are asking long form of SEBI. Long form of SEBI is there here. Right? These are not registered. These are not getting any approval from SEBI, but they are routing their investments. They are basically investing through FIIs in India. The P notes are among those investments which are considered to be offshore derivative instruments. Offshore derivative instruments. Right now, there's a technical term called as a derivative. Right? Derivative. Very complicated concept. Let me simplify this. What is the meaning of a derivative? Derivative is an instrument which doesn't have any independent value. I repeat, have a look at this. Right? Have a look at this. Derivative. What is the meaning of the term derivative? It is a deriving. Deriving means it is getting value from something else. Is it okay? It is a deriving. It's an instrument. It doesn't have any independent value. It will derive its value from an underlying asset, underlying instrument. For example, let me show a very simple example here. Take the same picture. Follow this carefully. Imagine I've issued a P note to you and I've collected $1. Simple, $1. And I've used that $1 to purchase a share of a company ABC in India. Now, can I simply say that if the value of the company ABC is a share, that is the market price of ABC share goes up, the value of your P note automatically will go up? Let me know, does it make sense or not? If, right, again I'll repeat it. I've taken $1, let's say $1 is equal to 100 rupees. I've used that 100 rupee to purchase share of a company in India. Now, if the market price of the share goes up, what will happen to value of your P note? Don't you think the value of the P note automatically will go up? What if market price of the share goes down? What will happen to the value of the P note? Value of the P note automatically will go down. Is the logic okay with all of you? Because rather than you directly investing, I have invested on your behalf. So your P note value is dependent on the market price of the share here. So if the market price of the share goes up, P note value goes up. If the market price of the share goes down, P note value will also go down. Right? So that is the reason this P note is one, offshore. Offshore means outside India. And second, basically it's a derivative instrument. Derivative means it doesn't have any independent value. The value of P note is connected to this investment in the stock market. If the investments will keep on changing, automatically the P note value will also keep on changing. Okay, that's the basic idea of the participatory notes. Is it allowed in India? Yes. participated notes are allowed in India, right? Very, very famous, especially in India. Participated notes are allowed in India, right? Although many RBI governors, right, they say there is a concern regarding this. Black money can be routed back into India, etc., etc. Okay, so this is the discussion regarding P notes. Done. Next concept is credit rating. The idea of credit rating. Now, what is the meaning of the credit rating here? Credit rating refers to the ability or the willingness of a borrower to repay the debt. That is, what is the capability, or let's say the capacity of a borrower to repay the borrowings, that is called as a credit rating. Right? For example, imagine a company is there. A company is issuing a bond, which means they're borrowing. Any problem here? Right? A company is issuing a bond, which means they're borrowing from the market. And when they borrow from the market, they are there in the debt. They are under debt. Now have a look at this. Because they are under the debt, what is the capability, right, or what is the willingness of this borrower to repay the debt? That is measured in the form of credit rating. That is given in the form of credit rating. So what do you mean by measured in the form of credit rating? Please have a look at the table at the bottom. Please have a look at the table. Generally in the global market, there are three types of global credit rating agencies. I hope you understand. There are three types of global credit rating agencies. Right? There are three major global credit rating agencies. Are there any other credit rating agencies? Of course, yes. Apart from these, there are many others. But more than 90% of the credit rating market is occupied by three US companies. One is S&P, Standard and Poor. Second one is the Moody's, and the third one is Fitch Credit Rating Agency. Now, some of you are saying, sir, is it like a CIBIL score? CIBIL score is given to individuals. I hope you understand. You will have a CIBIL score. I will also have a CIBIL score. But in case of credit rating, this is generally given to, let's say, a government instrument or government for that matter, or it is given to companies for that matter. Have a look at this. Have a look at this. The three very important international agencies are one, Standard and Poor, Moody's, and Fitch. Right? Moody's and Fitch. Now, whenever I say credit rating, the credit rating in simple terms is a representation. It is a representation of willingness or the ability of the borrower to repay the money. Now, how do we represent it? If I say it's a representation, how do we represent them? Either only alphabets are used, or a combination of alphabets plus numbers are used. It is either represented only in the form of alphabets, or it is also represented in alphanumeric form. For example, look at Moody's here, and do not buy heart the whole table. Do not buy heart the whole table. For civil services, this table is not required. Remember the concept using the table. Right? In case of Moody's, can you see a combination of both alphabet as well as numbers? Think of it. Can you see the combination of both alphabets as well as numbers? Whereas if you look at the first as well as the third column here, you will realize that, okay, it's basically, right, the idea of alphabet. Right? That is point number one. Point number two, what do they actually represent? For example, we have a triple A, we have triple B, we have triple C. What do they actually represent? Always remember this. The one at the top simply means it is the highest credit rating. It is the highest credit rating. Right? When you look at the table, when you look at the top here, that has the highest credit rating. That is highest credit rating. For example, imagine you want to purchase a bond of Government of India, and bond of Government of India is rated, let's say, triple A. It simply means that this bond has the highest credit rating. Right? Very, very safe to invest. Right? That's a basic idea. But if you keep on moving towards the bottom of the table, from the top, if you start moving towards the bottom of the table, the rating will keep on decreasing and the risk will keep on increasing. The rating will keep on decreasing and the risk will keep on increasing. For example, imagine there's a bond in the market and the credit rate for this particular bond is, let's say, D. Or let's say C in case of Moody's. Now, what does it mean? This is a bond which carries highest risk, right, wherever you invest in them. Is it okay? This bond carries the highest amount of a risk when you invest in these particular bonds. Right? So whenever you are at the top of the table, credit rating is very high. As you keep on moving towards the bottom of the table, credit rating will keep on falling, risk will keep on increasing. And that's the reason, remember this, the table or the rating is divided into two parts. Rating is divided into two parts. I'll number them 1 and 2. The ratings which will fall in the 1, that is from AAA to triple B. From AAA to triple B, these are called as investment grade. Any rating that will fall in the one category, it is called as investment grade. Right? What is the meaning of investment grade? Risk component is lesser. Right? The risk component is lesser. Whereas if your bonds will fall below the first category, that is, let's say, into double B, triple C, double C, D, etc., this category is referred to as junk grade. This is referred to as junk grade or speculative grade, which means if you're going to purchase these bonds, you're going to have very high amount of risk. This is a basic idea of credit rating. Now, what is the use of this? Some of you might be thinking, sir, what is the use of this? Imagine you want to invest in the market. A bond is there. It has a credit rating of D. Think of it. Right? I'll just give you an example. Here is a government bond and here is a corporate bond. Okay. I'll ask a question. Follow the discussion. Here is a government bond which is offering 6% rate of interest. That is, let's say, yield rate. Here a company wants to issue a bond. It has got a junk credit rating of D. You tell me, will you demand less than 6% coupon rate, 6% coupon rate, or much higher than 6% coupon rate? Think of it and answer. Will you simply demand, let's say, sir, government is giving 6%, give me 6.1%. Or will you demand, sir, I want 8%, I want 9%, I want 10%. Or, right, some of you charity-based right, investors, will you demand, sir, government is offering 6%, give me 2%, I'm happy with that. Absolutely no. You should demand much, much higher than 6%. Maybe 7, why not 8, why not 9? Why? 1, compared to government, is it not risky to invest in corporate bonds? Think of it. Compared to government, is it not risky to invest in corporate bonds? Comparatively, yes. Second, within the corporate bond itself, it has got a rating of D, which means it is very, very risky for you to invest in this bond. Risk component is very, very high. Right? So will you demand 6%? No, you should demand much, much more. Right? So can I simply say credit rating will be used by the investors? Is the logic okay? Will be used by investors in the market. What about the company? And let's say a company wants to issue a bond, that credit rating is a AAA. And have a look at this. The company wants to issue a bond, the credit rating is AAA. Now you tell me, can the investor demand a very, very high rate of interest on AAA bonds? Think of it. Can an investor, for example, you are the investor, can you dictate terms to the company? Can you tell the company, no way, give me 10%, give me 9%? Absolutely no. Why? Now the company will have the leverage over you. The company will have a leverage because look at the credit rating, highest credit rating. Very, very safe to invest. Safety component is higher, risk is very lesser. So why will they offer more rate of interest? They will dictate rate of interest now. So a company which has got a very good credit rating, now it will help the company to borrow easily from the market. It will help the company to borrow easily from the market. So understand the logic here. Credit rating is basically providing credit worthiness to the borrower. But what is the use of providing credit worthiness or indicating credit worthiness? Investors will use this in the market to make their decisions. Companies will use this to borrow from the market at, let's say, good rate of interest or easily borrow from the market, etc., etc. But have a look at this. Have a look at the next point here. Can the credit rating guarantee the performance of the company? Is it okay? Can the credit rating guarantee performance of the company? Absolutely no. Can the somebody says yes? Absolutely no, my dear. Absolutely no. They cannot guarantee, because let's say you're a company which has issued a AAA credit rated bond in the market. What if there is a fourth wave or third wave of the pandemic? You will completely incur losses, shut down. You tell me, right? So understand this, right? The market is very dynamic. Market is very dynamic. How you perform is dependent on so many factors. So the argument is, right, can the credit rating guarantee the payment? Of course no. It's an indicator. That's it. It's an indicator based on the past performance of the company. You can simply find out, okay, these are borrowed, these are repaid, right, etc., etc. But they cannot guarantee the performance of the company in the future. That's a precise reason. Understand this. Many of the times, even those companies that have got very good credit rating, they've defaulted. I hope you understand. That is a precise reason, right? Whenever the situations have happened in the market, back in 2008 it has happened, 2016, 17, 18 it has happened. A company which has got very good credit rating in the market, they have defaulted on the payment. It has happened in the past and it will continue to happen, because credit rating is an indicator, not a guarantee. It's an indicator of credit worthiness of the borrower. So these are generally used, right, for economies like this, or for even the government bonds or for corporate bonds, etc. What is the credit rating for India? Right, what is the basic idea of credit rating? Sovereign credit rating for India. Please have a look at this. The sovereign credit rating is either BBB or Baa3. For India, the sovereign credit rating is either BBB or Baa3. Now, if you look at the table, where does BBB or Baa3 fall? Is it okay if I say this? It is in the lowest tier of investment grade. Let me know. The sovereign credit rating, it is in the lowest tier, lowest level within the investment grade. Now, what if one more level we are downgraded? Think of it. What if we are downgraded by one more level? Our instruments will basically fall into the junk grade. Our instruments will basically fall in the junk grade. Right? And if they fall in the junk grade, it will become very, very difficult for the government to borrow at the current rate of interest. Nobody will purchase these bonds at the current rate of interest. Now the government has to offer higher rate of interest. Right? There are a lot of issues here. Okay? Done? So this is a discussion regarding the concept of credit rating, idea of credit rating. Now some of you are asking how credit rating is determined. You don't worry. Why? I'll tell you. Generally, from one company to another company, the methodology they use will be different. It's okay, from one company to another company, what kind of methodology they use will be different. And what parameters are considered, they'll also be different. So there is no uniformity. I repeat, there is absolutely no uniformity in the process of methodology of credit rating. And you don't have to read that. That is nowhere relevant to UPSC. Okay? Next, concept of mutual funds. Idea of mutual funds. Now, what is this mutual funds? Look at the definition. Many of you keep on asking me, sir, definition. The first line itself is the definition. And tell me, looking at the definition, how many of you understood what is a mutual fund? I'll read it out for you. A mutual fund is a type of investment vehicle consisting of a portfolio of stock, bond, and other securities. Now, do not worry about the definition. Let me explain it. Then we'll look at it. Generally, whenever you come across the term portfolio means collection. Any difficulty understanding the term portfolio? The term portfolio means collection. Right? What is a collection of securities? Collection of bonds, collection of, right, let's say, shares, etc. So portfolio means collection or a group like this. So why is a mutual fund referred to as a type of investment vehicle which consists of collection or a group of shares, bonds, etc. Let me explain it. Have a look at the picture here. Have a look at the picture here. Is the picture visible to all of you? Right? Now, let's start. Here is the investor A or investor 1, 2, and 3. Let's say there are 3 investors. These 3 investors, for whatever reason, they do not want to directly invest in the market. I hope you understand. They do not want to invest directly in the market. So what could be the reason? They may not have time. Is it okay? Right? Have you not seen many people who do not have time because they are busy preparing for UPSC, or they are working, they are busy with that work, this work, etc. But they want to invest in the market, earn certain returns. There will be certain investors who want to invest, but they do not have market knowledge. They do not know how the market operates, when to sell, when to purchase, when to short, etc., etc. They don't know it. So is it okay if I say, right, there are many investors who want to invest in the market, but they do not want to invest directly. They want to go through certain, right, investment options available to them. So one such option that is available to them is a concept of mutual fund company. There's a concept of mutual fund company. It's a type of investment opportunity available to the investors. Now what will happen? Follow this carefully. Follow this carefully. The mutual fund company will collect the money from the investors and they will invest in the market. Is it okay? Mutual fund company will collect the money, that is the investment, from the investors, and they will invest in the market. Point number 1. Point number 2, imagine this is a situation. I am the mutual fund company, you are the investor, I have taken investment from you. In return, should I issue any instrument or not? Let me know. Right, I've collected, let's say, 100 rupees from you. Should I issue any instrument to you? How do you know you've invested 100 rupees with me? So what I will do is, in return, I will issue instrument. I will use a color, right, this thing here, red color. Please have a look at the arrow mark here. Please have a look at the arrow mark. So this is one arrow mark. So from mutual fund companies, the arrow marks are basically going to the investors. And on the other side, there is one more arrow mark, the green color arrow mark. Right, the money is going, the investment is going from the investors. So have a look at this. Investors are giving the investments from mutual fund company, and in return, the mutual fund company is issuing an instrument to the investor. This instrument that the company is issuing, that I am issuing to you, it is called as a mutual fund unit. It is called as mutual fund unit. Sir, what do you mean by mutual fund unit? Let me give a very simple example. The mutual fund companies are allowed to issue, let's say, equity mutual funds. Equity mutual funds. What is the meaning of equity mutual funds? Imagine I've collected certain amount of investment from all of you under equity mutual fund. Majorly, this amount I will invest in the equity market. Predominantly, I'll be investing this amount in the equity market. Any difficulty in understanding this? Let me know. There's a connection to current affairs, right? So in the equity market, I'll be investing. Point number 2, there is also a debt mutual fund. There is also debt mutual fund. What will happen in debt mutual fund? I will collect your investments. I will invest this money in the debt instruments. So what is equity market? My goodness. Right, for last 1 hour, what do you think we are discussing? Equity markets are those markets where shares are traded, my dear. Right? Please focus on the discussion. It simply shows that you're not even focusing. Okay, so second example, the mutual fund company will collect money from you. They will invest in the debt instruments. Most of the investment will go into the debt instruments. These are called as debt mutual funds. Done. So equity mutual funds and debt mutual funds. Right? This is the point. Now let's say hypothetically, I want to collect 1,000 rupees from you. From all of you, I want to collect 1,000 rupees. So what I will do? I will issue 10 mutual fund units. I will issue 10 mutual fund units whose prices are 100 rupees each. I will issue 100 rupees worth, right, every unit worth of mutual funds, 10 units to you. Imagine you will purchase one of those mutual funds. So can I simply say you have invested 100 rupees in the mutual funds? Let me know. Can I simply say you own one mutual fund unit and you have purchased one mutual fund unit and invested 100 rupees? What about investor B? Let's say investor B will purchase 6 mutual fund units, which means the investment done by investor B will be 600 rupees. Right? What about investor C? Remaining 3 mutual fund units will be purchased by investor C. Investment will be how much? Worth 300 rupees. So have a look at this. I'm a fund manager. I'm managing this fund. I've issued 10 mutual fund units to you. I've collected 1,000 rupees. If it is a debt mutual fund, let's say extreme example, 100% debt mutual fund, meaning what? All the money I will invest in the debt market. I will purchase corporate bonds. I will purchase government bonds, that is state development loans, or let's say the G securities of the central government, etc., etc. Right? So this is how the mutual fund company will collect the money, issue mutual fund units, and right, invest as per the proposal that has been put forward to the investors. They will either invest in the debt market, they will invest in the equity market. Generally, they will have a combination like this. They will have a combination: 40% in debt market, 60% in equity, 10% in equity market, 90% in debt market, etc., etc. Now, can I say that whatever debts are or whatever debt instruments they have purchased or equity instruments they have purchased, that is a mutual fund company, these are nothing but assets? Any problem with this? Right? I'm the manager here. I'm the manager of the mutual fund company. I've collected 1,000 rupees from you and I've purchased government bonds. Can I call this as assets? And who is managing these assets? Who is holding these assets? Who is selling them? Who is purchasing them? I'm doing it. Now, can I call myself as asset management company? Let me know. Right? Does it make sense to you or not? I have issued mutual fund units to you. I've collected money from you. I will use all this money to purchase bonds, let's say government bonds. I will call these government bonds nothing but assets. Who is managing these assets? Managing means who is purchasing, who is selling, who is again investing in either way, this way, that way, etc. Who is doing all of it? It is being done by the company. Now, can I call the company as asset management company? Okay, so that is the basic idea of mutual funds. They will also use the term asset management company. Do not be confused. They will manage the assets. They will invest in a debt market or they will invest in the equity market. Now, next point. How many of you think, looking at the discussion that we've had so far, how many of you think that you are not going to face any kind of a risk here as an investor? Let me know. How many of you think that by investing in the mutual funds, you are not going to face any kind of a risk? You should not think it. At least you should have seen advertisements. You should have seen advertisements. Have you not seen advertisements? Mutual funds are subject to market risk. Please read the offer documents before investing. Have you not seen those ads also? So no, sir, I was busy with UPSC preparation. So the argument is simple. Whether you're going to invest in the debt market or you're going to invest in the equity market, there is a risk involved. Some of you basically say, sir, what if I've invested in the government bonds? I hope you understand. Some of you ask me, right, what if I've invested in the government bonds? Is it risky? What if the government is Pakistan government? You tell me now, is it risky or not? I hope you understand, right? What if the government is Pakistani government or let's say Sri Lankan government? Are these investments not risky? Of course, yes. Right? So understand that there is nothing like 100% risk free in the market. I hope you understand. All you can say is that's the reason I've also ensured. Whenever I've discussed government bonds, I've told you this. I've said these are very safe. I did not say 100% safe. I said very safe. Risk is very, very less. I said. Right? I never said 100% risk free. If somebody does that, they're lying to you. Even the mutual fund companies are not supposed to say that because there is a risk involved. Right? But argument is simple here. Argument is simple. Whether you're going to invest in a debt mutual fund or an equity mutual fund, it all depends upon you. I hope you understand. Because if I'm collecting 100 rupees from you, I will have to tell you whether I'm going to invest in a debt market or an equity market. If I say, right, only debt market, then I should inform you that 100% of your money will go to debt market. If it is only equity market, right, have a look at this. I will have to tell you your money will go to only equity market. If it is a combination like this, 60% in debt, 40% in equity, I will have to inform you. I hope you understand this. That's a basic idea. That's a basic idea. And they will inform. By the way, those who have invested, they will immediately understand it. They will inform. But again, please understand. Can they come to you every day and ask you, right, sir, you have given me 100 rupees. Now I've invested in the government bond. Market price is falling. Should I sell? They cannot ask you that. I hope you understand. They cannot ask you that because by the time you pick up your phone, right, and say, let me think, let me check Google, etc., etc., what if the bond market has crashed? That's the reason. Understand this. They will tell you 60% in bond, or let's say 40% in equity, or 90% in bond, 10% in equity. That breakup they will tell you. Definitely they will tell you, right? But the decisions are done in real time. The fund manager will decide in which bond I will have to invest right now, which bonds I will have to sell right now, etc., etc. Right? So that is basically how the mutual fund works will right function. Is the logic okay? That is how mutual fund right will actually function. Now, please have a look at the definition all over again. Tell me, does it make sense to you now? Does the definition give you certain idea about what is mutual fund? Mutual fund is basically an investment option for the investor, wherein there is a collection, there is a group of shares, right? There's a group of bonds or other types of instruments. That is basically the idea of a mutual fund. Next one, I am the expert. I am the manager. I have taken your investments, invested in the market. Should I charge you money or not? Let me know. Should I charge money to you or not? Of course, yes. They will charge you money. They'll basically charge a lot of money to you. Please understand this. Nothing is done free of cost. They will charge money to you. So mutual fund companies will also impose certain charges and collect it from the investors. Collect it from the investors. Point number 3. So returns are guaranteed for the investors? No. Are the returns guaranteed for the investors? Absolutely no. Right? Remember this. Right? There is no guaranteed returns here. So then what if I want to sell the mutual fund? This is how the process will work. There are generally 2 types of mutual funds. One is called as an open mutual fund. One is called as an open mutual fund. Second one is called as a closed mutual fund. Let me start. Imagine I'm issuing one mutual fund unit to you, but I'll simply say you will have to keep that mutual fund unit with you for 2 years. Is it okay? I'll repeat it again. You're purchasing a mutual fund. But there's a lock-in period. Lock-in period simply means for 2 years that mutual fund will remain with you. You cannot return it to the company. Such mutual funds are referred to as closed mutual fund. Such mutual funds are referred to as closed mutual fund. But on the other hand, there is one more type, open mutual fund. You will purchase a mutual fund from me. Right after 1 week, you want to sell it to me. You want to give it back to me. You can do it. After 1 month, you want to submit it to me. You can do it. After 2 months, you can give it to me. Right? This is called as open mutual fund. So one is a closed mutual fund. Second one is open mutual fund. Now let's look at the next point. Imagine I've issued 10 mutual funds. Same example I'll take. I've issued 10 mutual fund units in the market. You have purchased, let's say, 1 mutual fund out of it. You are investor A. So I've collected 1,000 rupees from all these investor A, B, and C. Now I'll take this 1,000 rupees, purchase government bonds. Simple. Purchase government bonds. Now let's say hypothetically, you will come to me after 1 week, and it's an open mutual fund, and you basically say, sir, take back your mutual fund and give my money back. Take your mutual fund back and give the money back. Now please understand the next point. UPSC will not ask you the calculation, but understand it. The amount of money that is returned to you will depend upon what is the value of the asset on that day, closing day. I'll repeat it. The amount of money that they will give back to you depends upon what is the closing value of the asset on that day. And it should make sense to you. I hope you understand. It should make sense to you. Why? Rather than investing through mutual fund, imagine you had invested directly in the market, purchase government bond. You will sell the government bond today. Right? Understand the logic. If you had invested 100 rupees and purchased a government bond, don't you think the money that you will get after selling is whatever is the market price on that day? Does it make sense or not? Whatever is the market price of the bond that day, that is the same amount of money that you will get. Right? What if the market price is more than 100? Let's say 110. You will sell the bond at 110, you will get 110. What if the market price of the bond is 90 rupees? You will sell it at 90, you will get 90. Apply the same logic here. I'm a fund manager. I've collected your 100 rupee. It is part of 1,000 rupee. I've invested in the government bonds. So when you will submit the mutual fund to me, whatever is the price of the bond, that will determine how much money I will give you. For example, the value of the government bonds have increased. Market prices have gone up. I purchased at 1,000 rupee. Now the market price of the bonds is 1,100. Now you tell me the net asset value. They will use a term called as NAV. NAV refers to net asset value. NAV is net asset value. So the net asset value right now will be how much? 1,100. All of you agree? It is 1,100. And how many units are there? How many mutual fund units are there? 10 mutual fund units are there. So what is the value per unit of the mutual fund? Per unit of the mutual fund is 110 rupees. Per unit of the mutual fund will be 110. Of course, they will deduct certain charges, which is called as charges or expenses ratio, and they will return this 110 after deducting to the investor, and they will take the mutual fund unit. This is how the mutual funds will work. Okay, this is how the mutual funds will work. Again, just to make you become easier or understand it, I've assumed the market price of the bonds have gone up. Can the market prices of the bonds be lower than 1,000 rupees? Possible? Think of it. Right. Again, after this, we'll take a break. Focus on the discussion. Can the market prices of the bonds, when you submit the mutual fund, can it be lower? Of course, yes. It's possible. Very much possible. Right. Subject to market risk. So what if rather than 1,000 rupees, the market prices of the bonds have fallen to 800 rupees? Congrats. You'll get 80 rupees, much lesser than that, because again, there's an expense ratio. So that's the reason. This is how the open mutual funds and closed mutual funds or debt mutual funds or equity mutual funds will basically work. Done? Right. So points regarding this, I've given it. Have a look at it. Mutual funds will give small or individual investors access to diversified, professionally managed portfolios at lower prices. Mutual funds are divided into several kinds or various categories representing the kind of securities that they are investing in, right, etc. Mutual funds will impose a charge, right, called as expense ratio, and in some cases, commissions which can affect the overall returns earned by the investors. So these are certain points regarding the idea of a mutual fund. Now, is it okay? So then what investments through mutual funds will be costlier since they take charges, use returns per MP? Of course, based on the mutual fund, you'll have to pay charges. So what is your option now? You tell me. You do not know how the market works. You don't have time to invest, but you want to earn returns. How? You tell me. What is the option available to you? One of the options is mutual funds. Okay. Expense ratio is basically the expenses which will be incurred by the mutual fund company to manage your assets, and they will transfer those expenses. They will deduct the money from your amount. That's it. Okay. So before I take a break, let me address your questions. On borrowings and repayment, what is the rate of taxation? It depends from one instrument to another instrument. There is absolutely no uniformity here. What is the example of a primary market? Last week when I started with the financial market, I told you whenever you come across a term market, do not imagine there is a place. Right? That's a mistake that the students do. They imagine that, let's say RBI governor is standing with bond, right, in a chowk, and RBI governor is calling, 10 kabis, le lo. Absolutely no. Absolutely no. Everything is done online. I hope you understand. Everything is done online now, right? So there is no physical market. It is basically done online now. Okay. If a company has 100% equity, how to know how much shares it has? Look at the documents. In the document, everything is given. If a company wants to sell the shares, that's the reason I told you there is a market regulator, SEBI. Do you think SEBI will allow anybody in the market to sell the shares to public? Think of it. Does it make sense to you? Does it allow anybody, right? Anybody can enter into market and start selling shares? Of course, no. They will have to submit a lot of documentation, and those documents are open to public for looking. Because you're an investor, you should know whatever is the position of the company. How much shares, how much has, right? Who has how much shares, how much investments, etc., etc. Okay. For sovereign gold bond, I saw Grow app that interest rate is 5% annually and 2.5% for every 6 months. Can you please confirm the interest rate? As far as I know, it is 2.5%. Right? It's 2.5%. Every year it is 2.5%. I'll check it. Don't worry. Right? That number could be changed by the government because when they issued it, they initially said 2.5%. Right? So they will let's check it. Don't worry. What will be the rate of interest for call money market? As this will be based on repo rate or more than that. It will depend on demand and supply. Always understand this. It depends on supply and demand. There is no formula. It is always based on demand and supply. For example, let me know this. All the banks, they have taken whatever limit is there under repo with RBI. Is it okay? Right? Repo is there, facility is there. They have already exhausted it. And right now there is no repo operation conducted by RBI. Right? I hope you understand. RBI will say when they are going to conduct repo. Now you tell me, if all the banks want to borrow more and more now, will they not go to the money market? Think of it. Will they not go to the money market? And when they enter into money market and start demanding more and more money in the money market, especially let's say call money market, what will happen to the rate of interest in the call money market? In the call money market, the rate of interest of course will start increasing. And of course will start increasing. Can I give you one example? Earlier, when I was discussing banking, I told you there was a term called as liquidity, banking liquidity deficit. How many of you remember that? I've explained that to you. There was a term called as a banking liquidity deficit. Right now, tell me if there's a banking liquidity deficit, what will happen in the call money market? Will the call money rate increase or decrease? Let me check. If there is a banking liquidity deficit, what will happen in the call money market? The call money rate will increase or decrease? It will increase. It will increase. Automatically, it should increase. Why? The banks have deposited more money with RBI compared to taking loans from RBI. Now they don't have money. There is no liquidity in the banking sector. Overall banking sector, there is a deficit liquidity. Will they not start demanding more and more money in the call money market then? Of course, yes. Right? That's the reason the call money rate will start increasing. Now, what does RBI do? RBI will start infusing liquidity in the banking sector. Has it happened in the last 1 week? Type in the Google. I'll give a break in some time. Type in the Google. Automatically, you'll see the article there. Okay. Okay. So municipalities are now allowed to issue green bonds. How it is regulated? SEBI, simple SEBI. But please understand, whenever municipalities will issue, right, whenever municipalities issue the bonds like this, either it is just a municipality bond or a green bond, etc., they are not allowed simply to issue. They will have to follow guidelines. Right? Even municipalities will have to follow guidelines. For example, what do you mean by that, sir? Municipalities will have outstanding loans. In the last 1 year, they should not have defaulted on any of the loans. I hope you understand. In the last 1 year, they should not have defaulted on any of the loans. If you have defaulted, then SEBI will not allow you to issue bonds. A municipality should have a credit rating of these instruments, etc., etc. So there are conditions on those municipalities as well to issue bonds in the market. Done? Okay. So if there is already liquidity deficit in the banks, how will the demand in call money market? My dear, when I say banking liquidity deficit, it is overall banking sector. I hope you understand. It is overall banking sector. Overall banking sector means what? Concept of averages will pitch in here. Concept of averages will pitch in or not. For example, sir, what do you mean by concept of averages? Let me give a very simple example here. Imagine bank A. There is two bank A and bank B. Bank A has surplus liquidity. Surplus liquidity of let's say 50 crore rupees. Bank B has a deficit of liquidity of 100 crore rupees. Now tell me what is happening in the overall banking sector here. Overall banking sector, there is a liquidity deficit of 50 crore rupees. Now don't you think this particular bank B will go to the call money market and start demanding more and more money? Of course, yes. Right? This is how in the call money market, if the rate of interest, that is the call money rate will start increasing, it's an indicator that there's a liquidity deficit in the banking sector. Done? Okay. So let's take a break now. Let's take a break. I'll restart at 8:23. I'll restart at 8:23. I join back again at 8:23. Okay, welcome back. Am I audible? Am I audible? Okay, let's start. So next concept I want to discuss is the idea of exchange traded fund, ETF, exchange traded fund. Understand this carefully. Many of the books or many of these magazines make it very, very difficult for this concept to understand. Let's make it very easy. Now, let me start with a very simple example here. All of you eaten, let me know, all of you eaten a Jumps packet or not? There is a product available in the market, Jumps packet. All of you eaten? Now, imagine this is a Jumps packet. Have a look at this. Imagine this is a Jumps packet. And within the Jumps packet, you will see that there are different types of gems. One will be this color, one will be this color, right? Another will be this color. Now let's make it simple. There are 3 here. Don't worry, don't say sir, only 3. I want 10. Don't worry. So if you open the Jumps packet, what do you see? You will basically, right? You'll basically see 3 gems within the packet. A simple question to all of you: can you purchase only one of these from the shop? Can you go to the shopkeeper and say, I want red color gems? Of course, no. The shopkeeper says it's in the packet. Either you purchase the full packet, or you will not be allowed to purchase the packet itself. Right? Either you purchase the full packet or not. That's it. Packet will not be opened, and individually red color gems will not be given to you. Now come to the concept here. There is a certain instrument available in the market which is called as ETF. Come to the current affairs now. There is an instrument available in the market which is called as an ETF. Now, rather than writing gems here, what if I say there is, understand this, there is an instrument which is available which is group of securities. Have a look at this, which is collection of securities. That is, imagine you will purchase this one ETF. You will be purchasing shares of company X, share of company Y, and a share of company Z. Any problem here? What is this idea of ETF? ETF basically represents a packet or a group of securities. You want to purchase the ETF, and if you purchase this ETF, you have purchased a group of these shares. If you sell this ETF, then you basically sold the shares of company XYZ. Any problem here? Let me know. Any problem in understanding? This is the definition. This is basically the definition. An exchange traded fund is a basket of securities that trade on an exchange just like a stock, just like a share, just like a bond in the market. ETFs are also traded. But what is the difference between a bond, share, and an ETF? When I say bond, you'll purchase one government bond. Possible? Of course, yes. You will sell one government bond. Individual units you can purchase and sell. But when you say ETF, when you talk about ETF, it is always a group. It is never individual. It is always a group. Let's say shares of A, B, and C, or shares of X, Y, and Z, or let's say shares of E, F, G, H companies. So ETF is always a group. It is never an individual unit like this. Is the logic okay? And ETFs are bought and sold in the stock market. Right? Just like a bond and a share, ETFs are listed. ETFs can be bought. ETFs can be sold. Right? Any problem with the idea of ETF? Please do let me know right now, because I'll introduce current affairs now. ETFs are nothing but exchange traded funds, which is a basket of securities that can be traded in the stock market. These are listed in the stock market. Now let me go to the next point here. What if in this packet, I'll call this as a packet now. What if in this packet all are shares? Can I call this as equity ETF? Done. If in this packet all these right gems are nothing but shares, can I call this as an equity ETF? Yes. Rather than shares, what if all of these are bonds? X is a bond of one company, Y is a bond of another company, and Z is a bond of one more company. I'll call this the ETF as debt ETF. I will call this ETF as debt ETF. Now I hope it is clear to you. Equity ETF means in this ETF you will have only shares, equity instruments, and debt ETF means all the instruments which are there in the packet are nothing but right the bond ETFs. Right. So debt ETF as well as equity ETF. Are these present in the Indian market? Of course yes. Of course yes. NSE is known for this. Now National Stock Exchange is known for ETFs only. Now come to this. What is the current affairs here? Central government has issued 3 types of ETFs. Follow this carefully. Central government has issued 3 types of ETFs. 2 of them are equity ETFs. 2 of them are equity ETFs, and one of them is a debt ETF. I'll come to the debt ETF in some time. Focus on the ETFs, equity ETFs. The 2 equity ETFs are one CPSE ETF. What is CPSE? Central Public Sector Enterprises. Central Public Sector Enterprises. CPSE ETF. Central Public Sector Enterprises. Now, what has the government of India done? They have taken the 12 shares. Rather than government of India, it is more appropriately managed by a private sector company, Reliance AMC. What they have done is they have taken the shares of 12 companies. They have taken the shares of 12 companies. They have created ETFs. What is the meaning of it? You tell me what is the meaning of it now? If you purchase the CPSE ETF, 1 unit of CPSE ETF, it simply means you have invested in the shares of 12 CPSEs. Is it okay? Can I go forward now? If you purchased 1 CPSE ETF, it simply means you have invested in the shares of 12 CPSEs. Right? So because you have taken the shares of 12 CPSEs and have issued ETF, so you purchase, you have invested in 12 CPSEs. You sell, you are selling the shares of 12 CPSEs. Right? So understand this. In the CPSE ETF, which was launched in 2014, the 12 CPSE shares have been taken, stocks have been taken, and these are issued in the market. And the company which has been allowed to do this, managing the asset in the market, it is Reliance AMC. The Reliance AMC is managing these CPSE 12 ETFs in the market. This is one CPSE ETF. What about Bharat 22 ETF? Right? What about Bharat 22 ETF? Look at the name itself, you'll understand. You have taken the shares of 12 companies. I'm sorry, 22 companies, not 12. You have taken the shares of 22 companies, and all these 22 companies will come from right 6 sectors. Do not buy out the sectors. Do not buy out 12 companies. I'm sorry, 22 shares not required. So we have taken the shares of 22 companies, clubbed them. We have issued this as an ETF in the market, which means if you purchase one of these, you are purchasing shares from 22 companies. If you sell one of these, you are selling the shares of 22 companies. That is Bharat 22 ETF, again equity ETF, launched in 2017, and which private sector company, that is the AMC, has been given the right to manage this. It is the ICICI Prudential AMC. It is ICICI Prudential AMC. Okay, so one is CPS ETF, second one is Bharat 22 ETF. Both are equity. Is there any debt ETF in the Indian market? I'll show that issued by the government itself. But before that, most of you are worried about, sir, difference between ETF and a mutual fund. You tell me. In mutual fund, any guarantee, I'll go back to this picture. If there is a mutual fund, any guarantee that they will hold their investment always in XYZ? Let me know now. Right? There's a mutual fund company. Any guarantee that they will always invest in shares of company XYZ? Absolutely no. Based on the requirement, they'll keep on moving their funds from one share to another share, from the bond market to equity to bond. So whenever these kinds of real time, I hope you understand, real time is based on the information available. Based on the information that is available, whenever investments are moved like this, whenever investment portfolio will change, is it okay? Investment portfolio will keep on changing. This is right active investment. This is active investments. What do you mean by active investments? Today, a mutual fund company will invest in shares of company XYZ. Tomorrow, they feel the market prices will drop. The market prices will crash. They will sell the shares of XYZ, purchase the shares of ABC. Active investment. Active investment. On the other hand, imagine you purchase this packet, GEMS packet, that is ETF. You purchase this packet, which has the shares of XYZ. Now, you tell me, can you change the combination of this packet? Let me know. You have purchased one ETF here, which has the shares of company XYZ. You have purchased this ETF. Can you change this portfolio? Portfolio means collection. Can you change this portfolio? Absolutely no. Either you will hold all the shares of XYZ, that is whatever is there in the packet, or you will sell all the shares right within the packet. Can you sell only X shares? Can you sell the shares of only company X? Not allowed. Why? It's a packet. Either you purchase the full packet or you sell the whole packet. Can I call this as passive? Can I call this as passive? That is, you are not allowed to change the combination of the portfolio. I hope you understand. You are not allowed to change the combination of the portfolio. That is, you will purchase XYZ and keep it. That's it. Can you sell only the shares of Y out of this packet? I hope you understand. Can you sell only the shares of company Y out of this packet? It's like you are a shopkeeper. I can go back to GEMS example, you understand it easily. You have purchased the GEMS, you want to sell the GEMS now. Are you allowed to open the packet of GEMS and sell individually the units? No. You will either sell the full packet, you'll purchase the full packet. So you have purchased one ETF where there are shares of X, Y, and Z. You are not allowed to change the portfolio. You'll have to either hold the full portfolio, sell the full portfolio. But on the other side, mutual funds, can they change the portfolio? Right? Can they keep on changing the portfolio? Of course, yes, they are allowed to do that. Okay. Then so this is equity ETF. What about bond ETF? Debt ETF. Central government, right, post 2020 has been issuing bond ETFs. Right, has been issuing bond ETFs. What is this bond ETF? Have a look at this very carefully. What the central government has done is they have identified certain public sector companies which have AAA rated bonds. Is okay. Point number one. Center has identified the bonds which are having AAA rating. Now, is the logic of AAA rating okay with all of you? AAA credit rating. Now, what they've done is they've clubbed these bonds and they've sold in the market. But there is one problem. Right? There is one problem. What is the problem here? The problem is that the bonds have maturity period. I hope you understand this. The bonds are having maturity period. So how is that possible that you club a bond? What if there is a difference in the maturity period? For example, let me show you. Imagine there is a central public sector enterprise A. It has issued a bond which is having a maturity period of let's say 5 years and will mature in 2023. There is another public sector company B which has also issued a bond which is maturing in 2023. There is a public sector company C which has issued a bond which will mature in 2024. And there is one more company D whose bonds will mature in 2024. Let me ask you a very simple question. Can you club all these bonds only in one ETF? Possible? Think of it. Can you club all of these bonds in only one ETF? Not possible. Why? These two bonds will mature in 23 and these two will mature in 2024, which means half of your ETF will mature in 23, half will mature in 24. How is that feasible? So what Government of India has done is, whichever they have issued, focus on this point. In whichever year they have issued, that's not the point here. They should be maturing in the same year. I hope you understand this. They should be maturing in the same year. For example, let's say A has issued the bonds in 2015, but has a maturity period of 8 years. Is it okay? 2023 maturity period. Let's say B has issued the bonds in 2018, but will have a maturity period of 5 years. Now, can I club the bonds of both A and B because they have similar year of maturity? They are maturing in the same year. Can I club both A and B and issue this as an ETF? Done? Let me know. Can I club both A and B, right? The bonds of company A, company B, although they have been issued in different years, but they are maturing in the same year. Can I club these bonds and issue it as an ETF? And I'll call this as ETF 2023. Have a look at this. I'll simply call this as ETF 2023. Now, what does ETF 2030 mean? You tell me now. What does ETF 2030 actually mean? The ETF 2030 simply means all the bonds of the companies, public sector companies, which have been covered under this, AAA rated, and will mature in 2030 are clubbed in ETF 2030. The bonds are going to mature in 2030. What about 2031? All the bonds are going to mature in 31. What about 24? All the bonds are going to mature in 24. In fact, one more 2032 also has been issued now. So that's the basic idea. So in the bond ETF, Government of India has identified those bonds which have AAA rating, point number one, and second, right, which have same maturity period have been clubbed, and the company which has been allowed to manage these ETF, it is Edelweiss Mutual Fund. Just like insurance companies, there is one more, right, within the mutual fund companies or insurance companies, that's Edelweiss. Edelweiss, very, very famous, right? Edelweiss company or Edelweiss Mutual Fund company has been appointed as an asset management company for the Bharat Bond ETF. Done. So I hope the idea of ETF is clear to you, right? So one is equity ETF, second one is debt ETF. In equity ETF, we generally sell, right, the shares of the companies clubbed together. In debt ETF, we sell bonds of the companies clubbed together. Right, but the Government of India has issued CPSE ETF, Bharat 22 ETF, and Bharat Bond ETF. Remember that can be asked. Now come to the next concept here: corporate bond market. Right, the issues in the corporate bond market. Now this is very important. Why I'll tell you. Earlier we have discussed NABFID. Remember this? NABFID, National Bank for Financing Infrastructure Development. And one of the problems, if you remember the slide, one of the problems or the concerning areas that I had written was the bond market is not very well developed in India. I said bond market is not very well developed in India. Now let's try and understand why bond market has not very well developed and connect it to NABFID. Why it will become a problem. Let's start. Bond market is, especially I'm talking about corporate here. Corporate means private sector companies. Private sector companies, just like the government, are allowed to issue bonds, borrow from the market. But in case of India, when you compare the corporate bond market in India compared to, let's say, Western markets, corporate bond market is not very well developed. It is there. I'm not saying it is not there, but it is not very well developed. Right? How can I prove that? Let's try and understand certain factors here. First one, most of the bonds which are issued in India, are government bonds. Either you can say state government bonds or central government bonds. So how much? How much of the bonds are government bonds? If let's say 100 crore rupee worth of bonds are issued in India this year, more than 70% of it will be government bonds. Is the point okay with all of you? I'll repeat it. If 100 crore worth of bonds are issued in India this year, more than 70% of it will be government bonds, which means the corporate bond market is very, very small in India. The value of corporate bond market compared to government bond market is very low. Right? But if you see that in the Western markets, if you look at it in the Western market, the corporate bond market, they issue a lot of bonds. In fact, in many of the countries such as USA, the companies issue much higher than what the government does. Why? Why is that important? The corporates will find it very difficult to always rely upon banking sector to borrow. Is it okay? We have discussed asset liability mismatch, etc., etc. You want the corporates to borrow from the market, invest, and promote growth in the economy. But in a country such as India, corporates mainly borrow from the banking sector. Is it a good methodology to borrow? Is it a good way to borrow in a country such as India? Answer is no. They should be more dependent on bond market, external market, rather than being dependent only on the banking sector. Right? I hope you understand. So we need to ensure that corporate bond market will develop more and more. Right? More and more corporates will basically borrow and invest. That is point number one. Point number two: illiquid secondary market. Illiquid secondary market. What is the meaning of the term liquid and illiquid? Now understand this carefully. Imagine you purchase the shares of a company, and you will find it very easy to sell the shares of the company in the market. That is called as a highly liquid market. Highly liquid market. Is it okay? I'll repeat it again. You'll purchase the shares of, let's say, Infosys. Can you easily sell it in the market today? Of course, yes. There is a good demand for Infosys shares. You can easily sell it. I'm not worried about the pricing. Can you sell it easily or not? Are there buyers for it? You purchase the shares of, let's say, TCS company. Can you easily sell it in the market? Are there buyers for the TCS shares in the market? Of course, yes. So generally we say there is a liquid secondary market. Liquid secondary market means there is a supply and good demand for these kinds of instruments. What about government bonds? What are government bonds? Do we have a very good secondary market for government bonds in India? Of course, yes. You purchase a government bond, you want to sell it. Is there a demand for government bonds in India? Of course, yes. Secondary market for government bonds is also liquid. But talk about corporate bonds here. Talk about corporate bonds. There is no good secondary market for the corporate bond. That is, imagine you have purchased a corporate bond, you find it very difficult to sell it in the market again. Is it okay? And you find it very difficult to sell it in the market again. And there's a reason for it. Why? More and more investors in India are focused on government bonds, if not on the stock market. Is the logic okay? More and more investors are interested in stock market. And even if they want to invest in the debt market, they're interested more in the government bonds and not in the corporate bonds. Now you tell me, right, you know the situation now. You know that, okay, investors are interested in equity. Otherwise, they're interested in government bonds. Will you purchase more corporate bonds? Let me know. You as an investor, will you purchase a corporate bonds from the company directly? In the primary market, will you purchase more corporate bonds? So the demand for the corporate bonds automatically will take a hit. Any problem in understanding the second point? Any problem here? Because there is no good secondary market. We do not have a very well developed secondary market. Automatically, the demand for corporate bonds in the primary market would be affected. Third one, investor base is very narrow. Narrow means a very small types of investors or number of investors are very, very less. What do you mean by this? You tell me, until unless I discussed economics, how many of you knew that there's a concept of share market? There's a concept of bond market. And within the bond market also, I'm pretty sure many of you would have known share market. But many of you would have not known there is a bond market, and specifically within the bond market, there is a corporate bond. I hope you understand this. You have not heard of the term corporate bond. Bond you would have heard because you have seen the movie, right? 007, etc., etc. Bond you know. But you may not have known that there is a bond market for companies. Companies will issue bonds, etc., etc. So the point I'm trying to make it is very simple. First and foremost, not all the people in India invest in the market. Is the point okay with all of you? Not everyone in India will invest in the market. If you ask most of the people in India, where do you invest? They'll simply throw one word at you: bank deposit. I hope you understand. At a large chunk of Indian investors, right? If you ask them, where do you keep your money? Where do you invest your money? Right? So you ask them, do you invest in mutual funds? They will ask you, what is mutual fund? Right? You will ask them, have you invested in Adani shares? They will ask you, I've heard of Adani, but what is Adani share? You ask them, have you invested in a gold ETF? They'll ask you, what do you mean by ETF? So the argument is simple. First and foremost, very small part of the population, a very small part of the population actually invest in India. And most of their investments will go to bond market. What about other investors? They will invest in stock market. They will invest in stock market and not corporate bond market. I hope you understand. Very, very narrow investor base. Investor base means number of investors who are investing in corporate bonds are very, very less. Next one, lack of repo operations. Imagine you're a bank. Imagine you're a bank. You can invest in bond. It could be government bond or a corporate bond. Now you know that if you invest and purchase government bond, you can use it for repo. It is allowed. You can use it under repo. That is not allowed for corporate bonds. You tell me, will you purchase more government bond or corporate bond? I hope you understand the logic here. Right? You are a bank. You can purchase government bond also. You can purchase corporate bond also. But you know that government bonds you can use it for repo operations. Will you keep on demanding more and more of corporate bonds? No, your demand for government bonds will be very, very high. Okay. So lack of repo operation is also holding back the growth in the corporate bonds. Lack of diversity of different types of bonds. The new types of bonds. I hope you understand. Right? The new types of bonds, novel types of the bonds, we have started issuing very recently. Many of you will tell me, sir, there is a green bond, there is a masala bond, etc., etc. How many of you think green bond and masala bonds are there in India since 1990s? Absolutely no. The model of green bonds actually started post 2008. Masala bonds have started very recently. So new types of bonds, we need to introduce more and more types of bonds in the domestic market so that different types of investors will be attracted. Right? So these are some of the reasons why corporate bond market is not very well developed in India. Now connected to NABFID, you tell me, will the functioning of NABFID be affected by low development of corporate bond market or not? Let me know. Will the functioning of NABFID, because NABFID has to give loans. Simple. NABFID has to give loans. If the bond market is not very well developed, from where they will find it easier to raise capital? Right? So this has been holding back a lot of growth, a lot of development in India. Okay. Now, what are the reforms which have been taken now? What kind of reforms have been taken? We have discussed all of these reforms. Everybody will agree? Right? We have not skipped any one of these bonds. We have discussed a green bond, masala bond, additional tier 1 bond, as well as a tier 2 bonds. We have discussed all of these. Now, one more reform is there, which was announced by RBI, targeted long-term repo operation, TLTRO, targeted long-term repo operations. Let me discuss what is this targeted long-term repo operation. Under the targeted long-term repo operations, RBI will provide loans for a duration 1 to 3 years. Look at the term long-term here. Right? Look at the idea of a long-term. RBI says, generally under repo, what I do? I will give the loans for 1 day. I will give the loans for 7 days, 14 days, 28 days, like this. But under targeted long-term repo operation, no, I will not give you loan for short duration. I will give you the loan for 1 to 3 years. 1 to 3 years. Right? Have a look at this. A bank is allowed to borrow under this facility. Bank is allowed to borrow under this facility for 1 to 3 years. But there's a condition. There's a condition here. What is the condition? Any loan or any borrowing that the bank does under the TLTRO, they will have to use it to purchase the bonds in the corporate bond market. They will have to use the money to invest in corporate bonds. Can a bank borrow under the TLTRO, give it as a loan to agriculture sector? Not allowed. Can the bank borrow under TLTRO, give it as a loan for housing sector, education sector? Not at all allowed. Right? They will have to use these funds only for investing in the corporate bond. Now, when you say corporate bond, what if they end up investing in a bond with a credit rating of D? Is it not risky? What if they end up investing in a bond with a credit rating of C? Is it not risky? Of course, yes, these are very, very risky now. So what RBI says is, borrow from me, right, and invest in the corporate bond market, but with one condition. What is the condition? You'll have to invest only in the bonds which have investment grade. You're allowed to invest only in those bonds which have investment grade. What is the meaning of investment grade? Those instruments which will have a credit rating of BBB or above it. Those instruments, if you remember Fitch and right, Moody's have shown you this. Right? So the idea of investment grade is those instruments which will have a credit rating of a BBB or above BBB, such as a AAA, AA, single A, etc. like this. So now tell me, the banks will take more loans or take loans from RBI and the rate of interest is repo. Remember this. Rate of interest applicable on this is repo. So the banks will take more loans under this, purchase a corporate bonds. Will we improve the liquidity of the corporate bond market or not? Will we increase the demand for corporate bonds in the market or not? And so this is one more very important reform that has been taken by Reserve Bank of India, RBI, to promote bond market in India. Done. So these are the various important aspects of financial market that I wanted to discuss with all of you. Now let's solve questions. Let's solve the questions. Then we'll pick it up, or we'll pick up the next chapter. Okay. Now next, right? Solve the question here. Solve the question. Right. And those who are asking, sir, what is IFC? IFC is basically part of World Bank. IFC is a part of World Bank. Right? There is a concept called as World Bank Group of Institutions. IFC is one of them. Okay. Now solve the question here. Let's start. 58% have answered correctly. Because I said IFC is part of World Bank, most of you went with only option 1. Okay, let me solve it. First statement is correct. International Finance Corporation, which offers these bonds, is an arm of the World Bank. Statement 1 is correct. Statement 2, they are the rupee denominated bonds, right? Because masala bonds. And a source of debt financing for public and private sector. Statement 2 is correct. What was the process? I'll tell you. Just like the concept of, let's say, green bonds. Even the masala bonds are allowed to be issued by international organizations. What they do is, that is World Bank, they've issued the masala bonds outside India, raised money, and they've used it to provide loans for infrastructure projects in India. They've provided it as a loan to both the government as well as the private sector companies in India. That is basically the idea of IFC masala bonds. So 1 is correct, 2 is correct. Right option for the question will be option C, both 1 and 2. Both 1 and 2. Next one. So 59% have answered correctly. Let's solve it. With reference to Indian economy, consider the following statements. Commercial paper is a short-term unsecured promissory note. Promissory note simply means these are instruments which will guarantee the return to you. Promise. Look at the term promise. Promissory notes are those instruments which will guarantee the returns. Guarantee in the sense which will promise returns to you. Okay. So commercial paper, is it short-term? Yes. Is it unsecured? Yes. Promissory note. So first statement is correct. In fact, you can use elimination method also if you don't know how to directly do it. Certificate of deposit is a long-term instrument. Is it a long-term instrument? No. So 2 is wrong. Whichever has option 2, eliminate it. Come to statement 4. Zero coupon bonds are interest-bearing short-term bonds issued by the scheduled commercial banks to corporation. Do they carry any interest? No. So eliminate 4 as well. Anyways, third one is most straightforward, very straightforward, simple statement. Core money is a short-term finance used for interbank transactions. That is from one bank to another bank. That is interbank. Third is correct. So the right option for the question will be option C, 1 and 3 only. Next one. Okay, why should have been higher? With reference to the Indian economy, what are the advantages of inflation indexed bonds, IIBs? Government can reduce the coupon rates on its borrowings by way of IIBs. Of course, yes, we have discussed this. IIBs provide protection to the investors from uncertainty regarding inflation. We have discussed this also. Inflation indexation is done. The interest received as well as the capital gains on the IIBs are not taxable. Please understand, tax benefit is not given on this. Tax benefits are not given. These are taxable. Okay. So third statement is wrong. Wherever 3 is there, eliminate it. Otherwise, directly go with option A, 1 and 2 only. In fact, for example, sovereign green bonds. We have discussed sovereign green bonds. Right, I'm not written it, but there is no tax benefit if you invest in sovereign green bond. At least as of now. Right, if you invest in the sovereign green bond, there is no tax benefit given on the investment like this. Okay. Done. Now it is taxable as a short-term capital gains tax. That's what I said, right? So taxes are imposed on it. Okay. So then let's start now. Next chapter. Right, let's start the next chapter now. The international trade. Important chapter. International trade. What we'll be discussing, right? In the international trade, we'll discuss exchange rate systems. Important. Exchange rate systems. Balance of payment. Foreign trade policy. World Trade Organization. Economic integration. And as usual, the questions. Okay. As usual, the questions. Please be very careful. A lot of current affairs I'll be discussing here. Please focus on the discussion. Let me start with the exchange rate. Let me start with the basic idea of exchange rate. Now, understand this. India is an open economy. I'll write a term here. India is an open economy. Sir, what do you mean by open economy? A lot of transactions will happen between India and the rest of the world. I repeat, what do you mean by open economy? Whenever transactions will take place between one country with the rest of the world, the economy is called as an open economy. For example, sir, what kind of transaction? Don't worry about the slide. I'll come back to this. Have a look at this. Can I simply say these are the various transactions which will either lead to inflow of currencies into India or outflow of currencies from India? Please glance. Please look at them. Right? These are the various transactions because of which currencies will either come into India or currencies will go out of India. For example, imports. Right? Imports. Right? Let's say students from India going to, right? Let's say university in London. Right? Indian tourists going to, let's say, UK. So in all these cases, what will happen? What will happen to the currencies? Can I say dollars will flow out of India? Let me know. Can I say dollars will flow out of India? Examples I've given. Have a look at it. But on the other hand, because of these transactions, that is, let's say, right, I will export certain goods or services to USA. Right? The USA citizens will come to India for healthcare purposes, surgery purposes. Right? Let's say I've exported a product into US market, or my friend is sitting in USA. They will send a certain gift to me. Right now, can I simply say because of all of these, there is inflow of dollars into India? So understand the logic here. Whenever you talk about open economy, whenever you say a country is an open economy, because of various transactions which could be related to, let's say, factors, which could be related to factors as well as non-factors. I hope you understand, which could be related to factors as well as non-factors. For example, sir, what do you mean by factor here? Land, labor, capital, and entrepreneurship. Is the logic okay? Right? Land, labor, capital, and entrepreneurship. So don't you think because of these factors, there is either inflow of the currencies or outflow of the currencies? Right? So there are various situations because of which there are transactions which will take place between India and rest of the world. Right? That is the basic reason why we require to convert dollar to rupee and rupee to dollar. Is the logic okay? Right? Because understand this logic here. Because let's say you have exported this pen. You have exported this pen to USA. You receive the payment in dollars. Now, can you use the dollar in the domestic market? Can you use the dollar to pay wages to employees? Can you use the dollars, right, to purchase a machinery in India? Of course, no. Why? Rupee is our domestic currency. So what we need to do is convert this particular dollar into rupee. But there are also various situations. For example, let's say tomorrow by looking at all these discussions on economy, you might become very much interested in economics. You'll get enrolled in London School of Economics. You'll go to London to study economics. Now, when you go to London to study economics, you'll have to pay fees in dollars. That is pound again. You'll have to pay, right, for tuition fees, books, etc. in a foreign currency. Now, don't you need to convert your domestic currency into foreign currency? Of course, yes. So understand the logic here. Because there's an open economy, there is always a need to convert domestic currency into foreign, foreign into domestic. Now, whenever you convert these currencies, this is called as an exchange rate. Is it okay? Whenever you convert these currencies, this is referred to as exchange rate. For example, you read in the newspaper, $1 is equal to, let's say, 78 rupees. Read it in the newspaper, $1 is equal to 78 rupees. Now, right, understand this. What is the use of this information? It simply means, imagine you want $1, you cannot print it. I hope you understand, you cannot print $1. You can go to the forex market. For example, in the forex market, who is there? Banks. Banks are the most important participants in the forex market. You will go to the forex market, you will give them 78 rupees. Of course, they will charge a spread. There's a term called a spread commission. Right? You will pay 78 rupees, and in return, the bank will give you $1. The bank will simply give you $1. Right? That is basically the conversion. This is called as exchange rate. This is referred to as exchange rate. That is how much domestic units of currencies are required to convert into 1 unit of foreign currency. How many units of domestic currency are required to convert into foreign currency? Explain again. My dear, I'm saying you want $1, you will go to a bank, you will give them 78 rupees, they will give you $1. This is how the conversion is done. Right? So there are many banks. Again, there are many banks. HDFC is there, ICICI is there. There are many banks which will provide you services like this. Or else, have you heard of Western Union? Have you heard of Western Union? Even Western Union will provide the exchange rate facility, but that is mainly for remittance services. That is mainly used for remittances. What do you mean by remittances? Remittances simply means making a payment, a transfer payment. Making a transfer payment. For example, have a look at this. Whenever you pay for your parents, I hope you understand. Whenever you pay, you like transfer funds for your parents. For example, imagine you have shifted to USA and you become a millionaire in USA. Millionaire, right? Congrats, you become a millionaire. You want to transfer certain funds for your parents, relatives, right? You are allowed to do that. This is called as a remittance. You'll also pay a certain amount of money for gifts. That is also called as remittances. So whenever you are transferring funds for welfare for relatives like this, right, for gifts like this, that is called as remittances. And remittances in simple terms is called as a transfer payment. Do you remember the term transfer payments earlier? Right? Let me check. Do you remember the term transfer payments that I've used earlier? So where have you used it? I've used the term transfer payments when I was discussing GDP, gross domestic product. Right? These are nothing but these are one-sided transfers. Because understand the logic here. Imagine I will export this pen. You will pay me $1. Is it one-sided transfer? Think of it. Is it one-sided transfer? I've sold the pen to you. You've given money to me. But on the other hand, imagine you're sitting in USA. You're a millionaire. You will transfer certain funds for welfare of your parents. Will you demand certain services from them? Right? Will you call up your mother and say, see, I've transferred money into your account from USA. Now start manufacturing and send certain product to me. First thing they will do is use that money, take a ticket of USA, come to your home and hit you very nicely. Right? Especially Indian mothers will hit you. So come back to the discussion here. Transfer payments are nothing but one-sided transfers. One-sided transfers. Right, now let's start. Right, so it is a minimum number of units which are required to purchase one foreign currency. Sir, why do you always use a dollar? Right, some of you are asking, sir, why do you always use dollar? Please understand. There are many currencies in which we conduct a trade. We conduct trade in terms of let's say pound. We conduct a trade in terms of let's say yen also. But most of the trade that we do, not just us, in the global market, most of the trade that happens in the global market, more than 90% of it is in dollars. That's the reason again and again I keep on comparing rupee versus dollar. Right, understand it. The next question is, sir, you have written $1 is equal to 78. How do we decide it? How do we decide $1 is equal to 78? And sometimes I read in the newspaper, $1 is equal to 80 rupees. How is that? It has moved like this. Right? Simple logic here. Understand this carefully. There are two methods. In fact, I'll introduce third one also. Have patience. There are two methods using which we determine exchange rate. One is called as a fixed exchange rate. Second one is called as a floating exchange rate. Right? One is the fixed exchange rate. Second one is a floating exchange rate. Now, in case of India, do we follow fixed and floating? Right? Or fixed or floating? In case of India or most of the countries, we follow more of a floating exchange rate. But that is the third one. In case of India, the exchange rate that we follow, it is called as managed floating. Right? It's more of a floating exchange rate, but it is called as a managed floating exchange rate. Now, what is this idea of a fixed exchange rate? Let's say hypothetically, the government or the central bank today will announce to all the people in India, $1 is equal to 60 rupees. Understand the logic here? Right? Have a look at this. Imagine government of India, or let's say any authority authorized by the government of India, will make an announcement. $1 is equal to 60 rupees. Now, doesn't matter what happens in the market, doesn't matter. We will always keep on using $1 is equal to 60 rupees. We will always move towards $1 is equal to 60 rupees only. We'll keep it at $1 is equal to 60. Now, can I call this exchange rate as fixed exchange rate mechanism? Let me know. Can I call this exchange rate mechanism as a fixed exchange rate mechanism? What is this fixed exchange rate mechanism? The government or the authority authorized by the government will determine the exchange rate and will always keep the exchange rate at that level. That is a fixed exchange rate mechanism. Right? Do we follow fixed exchange rate mechanism in India today? Do we follow that? Absolutely no. Absolutely no. Right? Now come to the other side. Floating exchange rate. Second one is floating exchange rate. Now, what is the basic idea of floating exchange rate? In the floating exchange rate, the market forces will determine what is the exchange rate. The market forces will determine what is the exchange rate. Now, what do you mean by market forces? The supply and the demand of currencies. Supply and the demand of the currencies will determine what is the exchange rate. Now, let me explain this. Follow this discussion very carefully. Follow the discussion very carefully. Now, what do you mean by supply and demand for the currencies? I'll come back to this, don't worry. Now, have a look at this. Imagine situation one. Just understand this carefully. Imagine situation one. Now, tell me, in case of India, there is a continuous inflow of dollars. Continuously, more and more dollars are coming into India. Now, you tell me, if dollars will keep on coming into India, what will happen to supply of dollars in India? Let's start. What will happen to supply of dollars? What will happen to supply of dollars in India? Can I say supply of dollars will increase? Supply of dollars will increase. Now, dollars are coming to India. Can we use dollars in India? Can we use dollars? No. What we need to do is, we will sell the dollars We will purchase rupees. That is exchange dollar with rupee. Now, if the supply of dollars is increasing, what will happen to the demand for rupees? What will happen to demand for rupees in the market? Let me know. What will happen to the demand for the rupees? Demand for the rupees will go up. The demand for the rupees will go up. So have a look at it. Continuously dollars are coming into India. Supply of dollar is increasing, and the demand for rupees is also increasing. Now you tell me, if the demand for rupees is increasing, what should happen to the value of rupee? What should happen to the value of rupee? Value of rupee should increase. Agreed. Anybody having a problem, let me know right now. Value of rupee increases. What will happen to the value of dollars? If continuously dollars are supplied in the market, what will happen to the value of dollars? The value of dollars will decrease. Value of dollar will decrease. For example, have a look at this picture here or table here. Have a look at the table here. Let's say today, the exchange rate is like this. $1 is equal to 50 rupees. And after 1 year, exchange rate is like this. $1 is equal to 60 rupees. One example. Example 2, today, exchange rate is $1 is equal to 50. And after 1 year, exchange rate is $1 is equal to 50. Now focus on example 2. Focus only on example 2. You tell me between dollar and rupee, that is today and after 1 year, this is the exchange rate today, this is the exchange rate after 1 year. Between dollar and rupee, can I say that value of rupee has increased? Let me know. Can I say that the value of rupee has increased and the value of a dollar has decreased? Again, some of you are asking why? Because you are looking at the volume. Do not focus on the volume of rupees here. Focus on value. Right? That is in the example 2. What you're seeing is value of rupee in 1 year has increased. Value of dollar in the same year has decreased because it is an exchange rate. We are selling one currency. We are purchasing another currency. So because it is an exchange rate, value of one side goes up. The value of the other side has to go down. It only makes perfect sense. It's like basically you have seen tarazu, that is the takriz. Right? If you keep weight on one side, right, this side will go down, the other side will have to go up. Apply the same logic here. Right? So have a look at this. In example 2, what has happened to the value of rupee? Value of rupee has gone up. Value of dollar has gone down. Any problem with example 2? Let me know. Any problem with example 2? Right? So whenever in the market, because of supply and demand, right? Because of supply and demand, right? Have a look at this. There could be a sudden rise in the supply of dollars. The value of dollar will go down. And because the dollar is converted into rupees, it simply means the demand for the rupees has increased. So the demand for rupee goes up, value of the rupee goes up. Right? Can I give you vice versa of this? I hope you understand this. Opposite of this, vice versa. Now what will happen in vice versa? Let's say Indian economy will start crashing. Again, underline, let's say Indian economy falls into recession. How many of you think foreign investors will remain in India? I hope you understand. How many of you think foreign investors will be very happy? They will remain in India? No. They'll simply say, problem is there, I will go out of India. But now have a look at it. They have invested in rupees. Can they take out rupees from India? Some of you might simply say, sir, let them take out rupees. What is the problem? My dear, if they take out rupees from India, they take the rupees, go to USA. Who will use the rupees in USA? Think of it. Who will use the rupees in USA? Nobody uses. So what they will do? They will start selling. They will start selling rupees. They'll start selling rupees. Supply of rupee will go up. They'll start buying dollars. They'll start buying dollars. Demand for the dollars will go up. Demand will go up. Here supply has gone up. Now can I simply write rupee value will go down and dollar value will go up? Any problem with this? Rupee value in this example will go down and dollar value will go up. Right? So again, have a look at the example 1 here. Have a look at the example 1. In case of example 1, today for every $1 exchange rate is 50 rupees. And after 1 year, for every $1 exchange rate is 60. What does it mean? For purchasing the same dollar, after 1 year, you're paying more rupees. I hope you understand. Example 1. I'm talking about example 1. For purchasing the same dollar, after 1 year, you're paying more rupees. Does it not mean that value of rupee has come down? Right? So in example 1, value of rupee has come down, value of dollar has gone up. In example 2, value of a dollar has gone down, value of rupee has gone up. So understand the next point here. Understand the next point. Whenever the values of the currencies will go up, will go down because of the market forces. I'll repeat it. Whenever the value of the currencies go up or go down because of the market forces, we will use the term appreciation and depreciation. We will use the term appreciation and depreciation. And whenever the values of the currencies will go up or will go down because of the government, because government is changing, because government is fixing the exchange rate, we will use the term devaluation and revaluation. Simply use the term devaluation and revaluation. Now tell me how many of you think or how many of you seen devaluation, revaluation in the context of India? In Indian rupee case, right? When you're reading a newspaper, assuming you're reading a newspaper, how many of you seen devaluation, revaluation in the recent times? Is government of India devaluing or revaluing? Absolutely no. 1991, that was the last time we actually went for devaluation of the currency. But after that, absolutely no. Absolutely no. But there are various other countries. For example, China. There is always an allegation against China that they devalue their currency. There is, earlier UK was part of one of the mechanisms in the European market. They used to devalue their currency. But today, most of the countries will use the term appreciation, depreciation, which means they've allowed the market forces to determine exchange rate. They've allowed the market forces to determine the exchange rate. Hence, we simply use the term depreciation, appreciation. Now look at the table. Look at the table. Is it okay if I say? Is it okay if I say in example 1? In example 1, please have a look at it now. Rupee has depreciated. Let me know. In example 1, rupee has depreciated. Dollar has appreciated. If it is market forces. Rupee has depreciated. Dollar has appreciated. In example 2, rupee has appreciated and dollar has depreciated. Dollar has depreciated. Rupee has appreciated. Assuming it is market forces. Now, what if it is done by the government? If it is done by the government, then I'll simply say in the example 1, rupee has been devalued. Dollar has been revalued. I'll repeat it. In example 1, if it is done by the government, fixed exchange rate, rupee has been devalued. Dollar has been revalued. And in example 2, rupee has been revalued. Dollar has been devalued. Right? This is how the terminologies are used. We do not use the term revaluation, devaluation in India because we do not follow fixed exchange rate. We follow market determined exchange rates. Market determined exchange rate. There is a technical term called as a managed floating exchange rate, which I'll discuss tomorrow. Don't worry. Right? We'll discuss that tomorrow, not today. Right now, many of you are asking, sir, why the devaluation is done, why revaluation is done, why appreciation, depreciation. Please look at the table here. Please look at the table. Let me start. Right? Imagine rupee is either appreciating or rupee is getting right revalued, which means today $1 is equal to 50 rupees, and after 1 year $1 is equal to 40 rupees. Now focus on the imports here. Focus on the import. If you import it, let's say you have to pay $1. Simplified. You're importing, you'll have to pay $1. So today, can I simply say you're paying 50 rupees? Let me know. Today you're paying 50 rupees. After 1 year, how much rupees will pay? 40 rupees. So what does it mean? When rupee appreciates or when rupee is revalued, can I simply say imports will become cheaper? Let me know. Can I simply say imports will become cheaper? Anybody has a problem with this? Let me know right now. What about exports? What about exports? You're exporting and you receive $1. You'll export and you receive $1. So today you receive $1 means you'll get 50 rupees. And after 1 year, you'll receive $1, which simply means how much you're earning? 40 rupees. Can I simply say, just a second, you'll earn 40 rupees. I'll explain this. You'll earn 40 rupees. But you tell me how many of you will do this? Let me know. How many of you actually will incur losses, right, and basically export and earn 40 rupees only? You will not do that. You will never do that. What will happen? I'll tell you. Why return exports will become costlier? Let me explain it. Have a look at this. Have a look at this. Last point. This side we'll take it up tomorrow. Of course, if you have understood this side is much easier. Let me explain last point. After this, we'll stop the discussion. Imagine you want to export this pen. Price is 100. You want to export this pen. Price is 100 rupees. Today, $1 is equal to 50 rupees. Right? Today, $1 is equal to 50. So you'll export it, and what is the label you'll put on the pen? What is the label? $2. All of you agree? You'll label this as a $2 and export it. After 1 year, $1 has become 40 rupees. But you still want to earn 100 rupees. Including your profit, you want to earn 100 rupees. Now, how many of you will put the label of $2 on the pen? Let me see. How many of you will put the label $2 and export it? No. You will export it at $2.5. Now tell me, if you're going to increase the price of this pen, will the exports increase? Will the USA importer purchase more and more from you? Right? No. Your export competitiveness. Competitiveness means compared to other products, now your products have become costlier. Export competitiveness will come down. Exports will become costlier like this. Right? So this is basically the idea of rupee appreciation having an impact on the export competitiveness. Any idea here? Any problem here? Not any idea. Any problem here? Right? So export competitiveness will go down. You can simply write. In fact, I've written here export competitiveness will go down. Will go down. Okay. In fact, it should be here. Export competitiveness will go down. Done. So again, tomorrow we'll start from here only. Right? This should have been here. This should have been here. I'll correct it in tomorrow's PPT. I'll give it to you. Okay. So this is a discussion regarding the concept of exchange rate. Tomorrow we'll continue from the same slide. Okay. Now, any issues? Let me know. Difference between mutual fund and ETF. In ETF, combination is fixed. In ETF, combination is fixed. You will purchase group of securities. You will sell group of securities. That's it. You cannot change the portfolio of ETF. Whereas in case of mutual funds, they can always keep on changing the composition. Today they will purchase a share A. Tomorrow they'll purchase a share B, etc., etc. That composition will keep on changing. Please tell sir to give timeline about what we read or not in the economy. My recommendation, I've been telling this from the first class. Read whatever is there in the current affairs, whatever is relevant to the whole economy. Read it. If in ETF no change in portfolio, then what are managing? Somebody has to club these securities. Somebody has to issue these securities in the market. Somebody has to honor the payment and all of that. Management. Okay, done. Sir, when RBI is deliberately increasing dollar supply in forex market, will it be called as appreciation of rupee or revaluation of rupee? It's not specifically, understand this, it's not specifically that RBI is going to fix exchange rate. For example, many of you ask me, sir, but I've read in the newspaper, RBI is selling dollars, RBI is purchasing dollars. That's the reason, context of India, we use a term called as managed floating. It's not purely floating, it is called as a managed floating. How they do it, I'll explain that tomorrow, don't worry. But we do not fix exchange rate. We do not fix, let's say $1 is equal to 50, and RBI doesn't intervene till it will move towards $1 is equal to 50. It's not like that. Okay? That's a basic reason why we call it as a managed floating exchange rate. Difference between IPO and FPO. IPO means for the first time the company is issuing shares. FPO, the company which is already listed, company which is already completed IPO, they will go for FPO. Okay. So depreciation and devaluation quite similar. These are similar in the sense impact is same, but those who are doing are not the same. Why it is happening is not one and the same. Okay. Spread. What is the spread? Spread simply means imagine the exchange rate today is $1 is equal to 50. Right? Imagine the exchange rate is $1 is equal to 50. You'll come to the bank. I am the bank. If I simply take 50 rupees and give you $1, that is market. Right? In the market it is $1 is equal to 50. Why will I provide services to you? You tell me. Why will I provide services to you? There has to be certain incentive, no? So that's the reason the market exchange rate is $1 is equal to 50. But when you purchase this $1, they will charge 50 rupees plus a certain commission. That's the spread. The commission itself is a spread. Let's say $1 is equal to 51. You will pay 51 rupees. That 1 rupee is a spread for the bank. Okay. Done. Right. So let's stop the discussion here today. We'll pick it up from the same table. Again, I'm saying this should be here. This should be here. Tomorrow I'll correct it. Tomorrow you'll have the right PPT, right point as such. But again, once you understand how appreciation, depreciation will have an impact, you do not have to have the PPT. Automatically, you will only say what will happen to import, what will happen to export. Done. So tomorrow we'll start from this slide. Okay. Tomorrow we'll start from this slide. Okay. So see you tomorrow. Have a great day. We'll continue the discussion tomorrow morning sharp at 6 a.m. Thank you.